diversified. There will be implications if this continues to sell off as aggressively as it has.
OK, we'll certainly watch all of the names on that board then. Thanks to Mark for spending the past hour with us. The European Equity Market Open is next. This is Mainback.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737.
Equity trading on Fronting Like in London with Tom McKenzie.
And here are your top stories. Stocks are set to tank in European trading. That's after a red-hot US CPI print. Markets fear the Fed has lost control of inflation. European gas prices surge again on lower flows from Ukraine. We are live from the G7 meeting in Germany. Plus, crypto crash terror leads the plunge of so-called stable coins. Bitcoin falls further below $30,000.
Tom, let's look at the futures. First of all, the music is something that we don't have very often. This is a music that kind of goes to the anxiousness of the markets. So this is the picture for European markets. Overall, of course, there's a pressure that comes from some of the cryptocurrencies, and you wonder whether it affects, it's the world upside down, whether it affects treasuries and also equities.
And it's a reminder, as liquidity is withdrawn, you're going to get these pain points, and they're certainly seeing that in the crypto space as markets start to price in now, not just 50 basis points in June or July, but also in September as well. And we've seen that yield curve flattening. You've seen a bid for the long end, particularly pronounced today. We'll check in on that shortly. And of course, yields have been up certainly yesterday yesterday at the front end. So a sell-off at the front end, money flowing into the long end, and that flattening of the yield curve. Do you get to an inversion at some point? What does that signal about concerns around recession? The UK, look at this, the FTSE 100 is currently lower by almost 2%. We had the BOE's deputy governor speaking to Bloomberg exclusively and saying that more rate hikes are necessary. The Bank of England will have to rate hikes further, he said, in order to get inflation under control. The Spanish IBEX lower by 1.7%. We'll see how the other markets open as we wrestle as well with the geopolitics. Fascinating to hear Mario Draghi of Italy coming out saying it's possible to pay in rubles all of a sudden. A bit of an about face, it seems, from the Prime Minister over in Italy. We'll get more details on that from Maria Tadeo, who's on the ground at the G7. The Italian FTSE currently down 1.8%. Let's switch it on and see how things are playing out across these assets then. We'll touch on, of course, what is happening in crypto and the fact that currently you're looking at 26,000 on Bitcoin. There is a view that 30,000 is a number that keeps miners profitable. Below that number is a challenge for the mining part of the business. Currently 26,237, down 7.6% as Tether becomes untethered as a concern about liquidity. Across the Asian space, you've got losses of 1.8%. There's concerns about property developers in China. Once again, the futures over in the US and NASDAQ after closing lower by more than 3% yesterday. The futures pointing to further losses of 0.6%. Here you are on the US 10-year then, 283. There's a bid there down 8 basis points on the yield. Fran.
Yeah, a lot of pressure on all of these sectors. If we dig deeper into them, Tom, I have all of them in the red, and you can see actually there's not one stock at the moment that's gaining in the European trading session. Basic resources down some 3.7%, closely followed by travel and leisure, auto parts. The one that's not doing as badly is the telecom sector, but it's still down some 1%. We also have some big breaking news, Tom, out of Finland. Finland president and prime minister have supported joining NATO. This is just crossing the Bloomberg terminal, so I don't know what that means for equities, but certainly something we need to keep an eye on.
Well, we're very briefly going to touch on 3 corporate stories then before we get to that important geopolitical story with Maria. Allianz currently down 1.4%. We had the earnings update from that company. Flows reducing in terms of the asset management part of the business. We spoke to the CFO who thinks that ultimately they're going to be well positioned. Siemens is lower. Look at that, by more than 5%, taking a 600 million euro hit to their business as a result of their exposure to Russia. Telefonica is essentially unchanged at this point. Let's get back to that breaking headline then around Finland and the decision, it seems, then to join NATO, Francine. I believe these redheads are crossing right now. This is breaking news, Francine.
Yeah, it is big breaking news. Let's go straight to Maria Tadeo, who's in Germany covering the G7, where all of the ministers are also meeting. So, Maria, this is significant because we don't know how Vladimir Putin will take it and whether this brings us into a new leg in the war.
Yes, Francine. And now, of course, we hear from the Finnish president, the Finnish prime minister, suggesting that they will support this. Essentially, it's the first step towards a binding application. The idea is that from now until the end of June, potentially, the different NATO countries will explore this application and then could become official in the early summer. I think, Francine, at this point, it is almost no question that this will be approved by NATO. We've had signals from pretty much every political figure suggesting that they would back this. And of course, it is a huge earthquake in the face of European defense. I mean, this is happening in real time as a response and as a result of the Russian aggression on Ukraine. Now, this is a complete watershed moment from the country. It will undo decades of foreign policy when it comes to Finland. But again, a lot of this happening, as I said, in real time, but very much a consequence of that aggressiveness from Russia.
What are we expecting the Russian reaction to be then, Maria?
Look, I think, Tom, they've made it very clear, the Russians, that there will be some kind of repercussion on this. The Finnish, of course, they look at the situation in Ukraine and they do not expect anything physical to actually happen on the border, but they do worry about cyber attacks. They also worry about potential hacking. A lot of the cyberspace is something that concerns them. And I think, Tom, we're going to hear from the Finnish government potentially ask from security guarantees on the interim, so not NATO binding, but perhaps supported by NATO members on the interim between the moment that now they apply for this and the end of June, the very important NATO summit in Madrid that will happen that would certify this application.
Don't they have that from the UK? Wasn't that part of the decision by Boris Johnson? They have that security guarantee.
Yeah, they did. And actually, this was in Sweden yesterday, that picture of the two, Magdalena Andersson, the Prime Minister of Sweden, and Boris Johnson on a boat. She's wearing this life vest. At times looking a little bit confused. I'm not sure if that's about the skills when it comes to being on a boat by the UK Prime Minister, but he was already very clear in this, that the UK will support this decision from both Finland and Sweden, but also say that the UK will provide any assistance on the interim. Remember, a lot of this will be about the next 6 weeks. That is a critical period for the two. They're not a member of NATO. They want to become one. They're not backed by Article 5 of NATO, but nonetheless, they will need some type of guarantee from allies that if something were to happen, they would provide support.
Maria, thanks so much. Maria Tadeo there in beautiful Weissenhaus. Suddenly the destination of everyone looking at Bloomberg thinking maybe I go to Germany for my holidays. Of course, this risk aversion is deepening. Part of that is also the situation that is extremely unsettling, not only when it comes to inflation, but the commodity complex and what's going on in Russia. Let's get straight to Maria Weitmane, Senior Multi-Asset Strategist at State Street. Maria, thank you so much for joining us. The fact that Finland has said they want to join NATO, does it just add to already markets that are on edge?
Yeah, and I think you're exactly right. I think markets are very, very volatile. We don't see kind of the end of this volatility coming like anytime soon. And actually, I'll probably say more. We see we characterize current market kind of dynamics as investors' capitulation. So until recently, we saw quite. Okay, markets were going down, but there was some preference for quality assets. There was some preference for safer havens. Now everything is going down, and investors almost like throwing a towel in. And I mean, news like that are not going to make them feel more comfortable.
Okay, Maria, look, we love your insights. You're a pro at this. Look at the camera, please. Look at us. We want to see you looking down the barrel straight at us, because this is important. Your insights are important always. You've been constructive on these markets. You say you think there's a bottom in the market that is nearing. What are you watching for to give you that sense?
Yeah, no, I think you're right. So there are, I think markets have repriced much lower. I think we still have kind of robust equity like backdrop, but earnings season was okay, margins were fine. We see still some strengths in consumer. We see some strengths in particularly companies with stronger brand names. So there is kind of underlying quality, but as I said, markets are capitulating. So we need to get past this extremely high volatility, and then that can potentially be bottom. So underlying fundamentals are not terrible. That's kind of the point I keep stressing, but you can't fight the trend. You can't fight this really negative momentum. So you need to step back and wait for your moment.
Right, but Maria, so what exactly is dictating the trend? Is it crypto that's undermining stocks, and is this a world upside down?
I think it's like combination of factors. So today market looks at crypto. Yesterday it was inflation print that was higher than expected. I mean, we talked a lot about this idea of peak hawkishness that we kind of got to the to the most extremes. But yet again, you get another print that is saying actually all this kind of very, very aggressive policy policy tightening needs to be there. So it seems to be kind of almost every day there is a barrage of negative news, and we're not through yet.
How closely are you watching this yield curve flattening? I'm seeing another bid for US 10-year, currently a move lower by almost 10 basis points on the 10-year, currently at 282. Do you expect to see inversion? Is this starting to price in the markets a recession risk?
Yeah, no, I think actually yield curve is something, I mean, we watch obviously very, very closely, and for a long time our argument was that central banks cannot be too aggressive. Economy is not strong enough to take those extremely aggressive hiking because economy will slow. So that's important. And I mean, maybe one of the ways we kind of get out of this negative spiral is some realization, and that's probably a few quarters down the line that actually slowdown in economy would be something that will slow inflation. But we're not there yet, as I said.
All right, Maria, thanks so much. Maria Weitmane, they're Senior Multi-Asset Strategist at State Street. And of course, always interesting to see your thoughts, the ever-optimist, still saying you can't really fight the trend right now. Coming up, Boris Johnson promised to supercharge Britain by reducing regional inequality. So, has he done it? We'll bring you analysis that actually says he hasn't. That's coming up next, and this is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. We are 12 minutes into the European trading day. If I get my words out, it's really all about a bit of freaking out in the markets. You can see the European stock 600 down some 2.3%. If you look at a global benchmark to what global stocks are doing, it's just about into a bear market, so loss of 20%. Again, we don't understand whether it's crypto losing the stocks or something out there that actually the stocks are really freaked out about, which is inflation, but we knew it was there, and we have some great stories, including a nice exclusive from our UK team. So, the UK economy unexpectedly contracted in March as the cost of living squeeze saw consumers cut back on spending. Meanwhile, in an interview with Bloomberg, the Deputy Governor of the Bank of England, Dave Ramsden, says the BOE will have to raise rates further to control surging prices. He also warned there's a risk that the UK's worst inflation crisis in decades will take longer to ease fully.
Okay, so how is it all going? We have a scorecard on this, and we can work through it with our UK economy reporter, Lizzie Burden. Lizzie, let's talk about the GDP numbers first, and then we'll get on to your interview with the Deputy Governor of the BOE. What do the GDP numbers tell us? They're backward-looking about the future health of the UK economy as we weigh up these cost of living concerns.
Well, Tom, we saw an unexpected contraction on the month in March, 0.1%, which leaves growth of 0.8% across the first quarter. Digging into that, the retail sales figures previously showed that consumer spending is struggling to hold up in the face of surging inflation. So Bloomberg Economics sees a contraction in the second quarter, but not in the third, which means the UK will avoid a technical recession. But this really underscores the headache for the Bank of England, because on the one hand, it's got to manage surging inflation, but on the other, clearly, we're already seeing the weight of the war on the recovery.
So you have this great interview out. Congratulations, Lizzie, on an interview with the BOE Deputy Governor, Dave Ramsden, and he was basically looking at the upside risks to inflation. He says more rate hikes are needed, maybe pretty aggressively, and it's moved pound.
Yes, it has. Thank you. Well, he says that the labour market has often proved more resilient than expected. That creates these upside risks to inflation, hence the need for more tightening. He says the June meeting is an opportunity to take stock, so it'll be interesting to see how he votes. On the forecasts, he refused to endorse or reject the market curve, which of course shows that rates will rise to 2.5% by 2023. But that's what the gloomy forecasts from the Bank of England are based on, that we'll see the economy shrinking in the years ahead. He says, though, that that forecast isn't going to become some sort of self-fulfilling, gloomy prophecy in itself. People will understand that.
Okay, Lizzie Burden, thank you with those insights from the BOE's Deputy Governor, which saw the pound move on the back of that news. Don't miss the launch, by the way, of Bloomberg's new UK website with expanded coverage of all things Britain. You can find the new site at bloomberg.co.uk. Let's get back now to Maria Weitmeier, State Street Senior Multi-Asset Strategist. Maria, thank you for sitting tight for us. What is your view then on the UK and whether or not this economy can avoid a recession? Of course, there is the D-link, many would argue, between the UK economy and the FTSE 100 companies. How do you view the equity part of it and the economy side here?
Yeah, no, that's exactly right. I mean, UK, and you probably can argue that Europe is in a very similar situation where economies, clearly slowing, and as a result of war in Ukraine and higher commodity, higher input prices, higher squeeze on cost of living, the troubles consumers are saying, and you still have inflation, and central banks have to hike into it. So that's a real problem, and concerns about recessions are much higher in UK and Europe than, say, like maybe in US, where it's a little bit further away and consumer is in a better position. But as you exactly said correctly right, Tom, is that UK economy is quite de-linked from stock market, or stock market is de-linked from economy. And one thing we can say about UK stocks, they are probably one of the most defensive regions globally, and that's what's really helping UK stocks. And this kind of route we're seeing in the market, that if you need to hide somewhere, then UK stocks being kind of dominated by defensive and commodity sectors, to probably two areas that are holding up relatively better than other markets, so that benefiting UK stocks. So that's something we were kind of quite reluctantly overweighting in our portfolio, given the kind of the weaker underlying earnings backdrop, which we like, but it's defensive, so you have to own it.
Maria, what happens to sterling in this? It's unclear, for example, if we go to parity in euro-dollar and what the repercussion for pounds are.
Sterling has a kind of extra headwind to it with potential political uncertainty with ripping out of Northern Ireland protocol. So that's an extra complication, and that seems to be a very difficult problem that UK politicians are facing now. It's very difficult to see how that situation can improve, but for sure that's not going to be positive for sterling. So that's yet another negative. So you have economy, you have a central bank having to hike into slowing economy, and then you have a political trouble as well. So we are not a big fan of sterling.
Maria, let's just unpack very briefly before we let you go how you shelter in these markets. We're just looking at so much bloodletting now across these European markets, down no more than 2%. Crypto, we'll touch on that shortly, is getting crushed. Where do you want to be sheltering? Is healthcare and commodities, is that still where you want to be? How do you square your call on commodities with your negativity on China?
I think you're exactly right. It's trying to find areas to hide. So it's not like a very constructive portfolio in a sense. So we're trying to find some relative places relative trades which areas are likely to underperform less than others. So within defensive, as you correctly pointed out, healthcare is our favorite defensive. Commodities is probably an area that are going to underperform less, given there is kind of underlying catch up we still need to do for commodity stocks relative to underlying commodities and better kind of underlying fundamentals. But it is a challenging place. So we're trying to find areas that are maybe going to down less than others. Europe, we'll prefer US to Europe. Again, underlying fundamentals are a lot better. We like large caps, we like dividends, but it's all on a relative basis, relative to kind of longer duration assets.
Maria, thank you so much. Maria Weitmeier, their State Street Senior Multi-Asset Strategist. My only piece of advice is have an extra espresso. I know we were talking yesterday about the fact that espressos are not that good for you, but if you have the good kind, I'm like on espresso number 3, the only way to get through.
I noticed that you're back in the studio and prices of coffee have gone up through the roof again. I just wanted to check on it. Coffee prices up 8%. I think that's correct, live pricing there.
Are you kidding me? It's not me, it's the markets.
There's a correlation.
There's definitely a correlation with markets going down and consumption of coffee going up. All right, yen actually gaining, the yen advancing as there's a lot of the selling in stocks. That's hurting risk sentiment and US yields extending their decline. So some of the super long sectors led gains in Japanese bonds, as well as a 30-year sale was seen as sluggish, and that's giving a nice little lift to yen. Bitcoin, Bitcoin's crazy when you think about it.
Beautiful, just absolutely brutal. 26,000 30,000, look, are we going to cross below 25,000 today? 30,000 is seen as key in terms of profitability for miners. You're down 8% in the session. Ether also being smashed as well, down 13%. Of course, this is linked to Terra becoming untethered with the dollar and the inability of the team behind that to raise liquidity, additional funding, liquidity concerns front and center. You tie this into what is happening around rates, of course, the Fed and inflation. Euro dollar also under pressure, down 0.5%, 104. We've been talking about parity closer today on that, and a safe haven bid, as you said, for yen, 129, gaining 0.7%. Coming up, crypto chaos. We'll get more on this as Terra tumbles. The stable coin, which is meant to be pegged to the dollar, certainly isn't now, fails to maintain its dollar peg. That story is next. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 24 minutes into your European trading day this Thursday. Fear and loathing across these markets. A drop of 2.4% across your Stock 600, the European benchmark, taking a very big hit on the back of the losses we saw on Wall Street, the reassessment around CPI inflation, what it means for the Fed as the market prices in a rate hike of 50 basis points in September. Let's check in on the sovereigns as well. We have a significant move, particularly into the long end, the back end, the 10 years of the BTPs and the Bunds, the gilts, and the US 10-year, and you're seeing the yields moving down by double digits across many of these sovereigns. Just look on the Italian BTP just for a moment. You've got 11 basis point move there. When it comes to the German Bunds, a 10 basis point move. Gilts, 8 basis points, and the US 10-year, 9 basis point lower. So moving towards the back end, the yield flattening that we saw yesterday becoming more pronounced in the US as well. Concerns about recession, Francine.
Now, we're joined by Eddie van der Walt, of course, our Markets Live editor. Eddie, one of my favorite moments on TV is just before we go live, when we see you at the desk with like a million screens and you say, wow, what's happening to the euro? You look like, you know, a pilot on a cockpit looking at all the markets. What are you seeing that's crazy right now, apart from cryptos?
What you mean is you see a man in a constant state of panic trying to make sense of it all. And the markets right at the moment are really hard to make sense of, right? And particularly in crypto land. I mean, crypto, obviously, we're seeing a big drawdown here. Stable coins is where it's at. There's this worry about stable coins generally because the algorithmic stable coins have been in a little bit of trouble, I think it's fair to say. And stablecoins are really integral to the health of the crypto economy, and I think that's why we're seeing a big panic here. Now we've broken through that support at 30,000. Whether this drawdowns continue much further, I think the crypto space will be very worried.
Did you see this, Eddie? Did you see this picture of Novogratz with the tattoo with Luna on his left arm? You know, this is a man who's backed terror, right? And often the likes of Novogratz say, look, it's the institutional buy-in that ultimately is providing the fundamentals and the support for this space. What happens to institutional investors when they look at the market action over the last 48 hours?
Yeah, I mean, look, is the volatility of cryptocurrencies going to scare off institutional buyers? I don't think so. I think institutional buyers are smart enough to know that these are high beta trades, right? If you're gonna go in there, you've got to hedge your bets. It's going to be a small part of your portfolio. I think it's much more risky if you're a all-in maximalist on the cryptocurrency space, and as a private investor went all in. But that said, I think the institutional investors are much more worried about the overall health of the space.
Eddie, thank you so much. Yeah, we'll get back to crypto and euro dollar. Maximalists. This is Bloomberg.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Stocks set to tank in Europe trading. Well, they are tanking after a red-hot U.S. CPI print. Markets fear the Fed has lost control of inflation. European gas prices surge again on lower flows from Ukraine. We're live from the G7 meeting in Germany. And crypto crash. Terra leads a plunge of so-called stablecoins. Bitcoin falls further below $27,000. So, Tom, if you look at the markets, it's definitely a risk-off mood, but actually an ugly one, a deep one, and everything is just being sold off.
Nothing to see here, Francine, unless you're hiding under a rock. My goodness, look at this, down 2% across the benchmark. Everything is moving. Significant moves in the sovereign bond space. You're seeing moves into the long end, the 10 years, the BTPs, the bunds. You're seeing commodities from iron ore to copper to oil being crushed. And of course, everything that's happening within the crypto space as investors there weigh up that shrinking liquidity. So this is the equity move down 2.2%. Look at that across the benchmark. The DAX is lower by 300 points. The FTSE 100 lower by 2%. The BOE's deputy governor telling Bloomberg more rate rises are needed to get inflation under control. Let's switch it on and see the sea of red across these sectors then. Every single sector under pain today, under pressure, led by basic resources. I talked about the pressure on iron ore and copper and oil. That is floating through into the basic resources. That is a clear drag, of course, on the FTSE 100. Travel and leisure also, that would be a risk-on move in normal circumstances if you're betting on the revival post-pandemic, but today it's being crushed down more than 3%. Consumer products as well, also, of course, lower by almost 3%. Top of the list, but still lower by 0.4. Telecoms followed by insurance, utilities. That is the safe haven play, but they and those sectors also under pressure in this environment, given that inflation tick up that we saw stateside and the re-rating. Money markets now pricing in a rate hike of 50 basis points in September, and you're seeing that safe haven move towards the back end of sovereign bonds. Francine.
Yeah, U.S. inflation remaining above 8%. That's roiled stock markets once again. Well, not only stock markets, treasuries, but also cryptocurrencies. European equities have cratered at the open. Commentators left wondering if central banks can actually keep the lid on these rising prices. Well, Bloomberg opinion columnist William Dudley says the Fed has not been clear enough to the markets and is risking its credibility. He told us yesterday what level he thinks the Fed rate should hit.
I think it's 4 to 5 or higher. I was 3 to 4 maybe 6 months ago. Now I'm 4 to 5. Wouldn't shock me if I'm, 5 to 6 a few months from now.
In Europe, policymakers are increasingly embracing a scenario of taking interest rates above zero by the end of the year. Bank of France Governor François Villeroy de Gallo agreed publicly with this outlook last week, and his Belgian colleague, Pierre Wunsch, said that would be a no-brainer. Yari Sten, chief European economist at Goldman Sachs, joins us. Yari, how are you starting to factor in now the ECB's policy reaction, as I know that you and the team weigh up these secondary effects around inflation?
Yes, so the base case is that QE will end in June, but we will see the first 25 basis point hike in July. And as you just said, I think there's consensus building around this timing for liftoff across the Governing Council. There's still more uncertainty and more disagreement about the pace after that. Our own view is that the Governing Council will hike 3 times this year in total and 4 times next year. But there are risks in both directions. So on the one hand, higher second round effects, so rising inflation expectations, rising wage growth could lead to a faster pace. So we're skeptical they would go 50 basis point increments, but it's possible they would also go in October, i.e. 4 times this year. But then you also have risks, of course, on the other side related to the possibility of a gas ban, which we think would weigh on growth very sharply. And then, of course, also possibility of sovereign stresses as rates start to rise. So baseline for us, 3 hikes this year, but a lot of focus on second round effects, which could lead to a bit more.
Yeah, the problem is that, the markets just don't believe the ECB can hike, given they risk a recession if they hike interest rates. Are we going to see parity on euro-dollar?
Well, there's certainly been a lot of downward pressure on the euro in recent weeks, and it's feasible that with more divergence in the near term, that some of that could continue. But we actually think that the euro will rise again after that, as the ECB gets underway with a hiking cycle, and as the policy rate reaches zero again in the euro area. And one of the key reasons is that a lot of funds left Europe, a lot of reserve managers moved holdings out of the euro when rates were negative in the middle of 2014. We think it's about 3 trillion euros in total. And some of that could come back as rates go to zero and then go positive. So we actually think over a sort of 12-month horizon that the euro is going to recover somewhat from here.
Jari, are you and the team at Goldman starting to rethink your forecast for European growth this year?
Well, we are 2.5% for growth for the year. That's below consensus, is below where the ECB is. And I think that's the right place to be. We are seeing that the indicators are beginning to slow. In particular, in the industrial sector, we had very weak German industrial production. And then we're also going to get a significant hit, of course, to incomes and to the consumer in the second half of the year. So we don't have a recession in the forecast because consumers still have excess savings, have quite a buffer. We're still seeing fiscal support in Europe, but we do think growth is going to be pretty weak this year.
Jari, we're looking at a lot of UK data. Inflation, of course, hurting demand for houses. Inflation hurting the cost of living. We have grave concerns, given the Bloomberg News analysis, about inequality also on the rise. What do you do with the UK right now? Is it even tougher to set interest rates if you're the UK compared to the EU?
It is a tough spot, and the Bank of England faces a particularly difficult trade-off because you have, on the one hand, slowing growth with the cost of living crisis. We are also cautious on UK growth this year, but at the same time, you have a tight labor market and you have high wage growth and very high inflation. And so on the inflation picture, the UK really looks a lot more like the US. And so we think, on balance, what that means for the bank is that rates will continue to rise, but will not rise as high as in the US. Our forecast here is that we will see a 25 basis point hike in both June and August, that then the MPC will start asset sales in September, and that bank rate will then go up to 2%. But again, the risk of second round effects here means that we could see a terminal rate that is higher than 2% in the UK.
And double-digit inflation, double-digit print for inflation in the UK is still part of the forecast for the BOE. The Deputy Governor saying clearly more rates are needed. So aligning with your view on that in order to get these prices down. Just remind us, Jari, of the time frame, the lag between policy setting, and we've had 4 hikes now from the BOE, and how that starts to impact the real economy when it comes to prices. Are we seeing any of that filter through?
It typically takes some time. I mean, your typical rule of thumb is that it takes up to a year for a rate hike to affect growth, and then up to another year until the slowdown in growth then features in lower inflation, which is why, of course, policymakers are more focused on the medium-term outlook for inflation rather than these very high spot numbers. Now, that said, there is always a risk that these high spot numbers lead to these second round effects, which is why you do have to be attentive to those as well. So we have UK inflation peaking at almost 10% in October, and that is one of the key reasons why we think more rate rises will come.
Jari, when you look at what's happening on the political front, look, Liz Truss, we understand, could give an ultimatum to the EU on Northern Ireland before the UK scraps this protocol. What kind of economic earthquake would that lead to?
Yeah, I mean, it all depends whether the trading arrangement, the trading deal in the end is reversed, which could have significant effects, of course, for trade and for growth for the bloc as a whole. But I think what's more likely is that we're going to see tensions around this. Tensions have been here for some time, but we ultimately do look for a compromise to be found here that allows trade to continue on relatively favorable terms between the two countries.
Okay, Jari Sten, Chief European Economist at Goldman Sachs, walking us through the views there on the UK and, of course, the positioning from the ECB. Thank you, as ever, for those insights. staying with what's happening in Europe, just pointing out, euro-dollar currently 1.045, lower by 0.6%. Part of this will be down to dollar strength, but not all of it, because the dollar index is up just 0.3%. So greenback still coming into force, and then this safe haven move into the yen. The yen is back.
Yeah, the yen is back. Yen, dollar rally on haven bids, and crypto's having a meltdown. There you go. Coming up, carbon capture technology is more than a century old, but we speak to a London-based startup that's seeking to revolutionize, of course, this technology. That's next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. 43 minutes into your European trading day, and what a day. Losses of more than 2% across the benchmark. The CAC 100, the FTSE 100 and the DAX all lower by more than 2%. Every single sector is in the red. Part of this possibly catch up from the session yesterday on Wall Street, the Nasdaq ending lower by more than 3%. And of course, factoring in what is happening around inflation out of the US and the money markets, starting to price in now 50 basis points, not just in June and July from the Fed, but also in September as well. Future stateside also pointing to further losses of between 0.4 and 0.8%. Francine.
Yeah, it's really interesting also just hearing from some of the big guys saying exactly what's going on. We just heard from SoftBank saying, look, what's happening in the markets is a pandemonium. It just seems like it's a complete risk-off overall, and that's, of course, moving some of the yields. The Italian 10-year yield, 2.79. The UK, now we had a brilliant, our Lizzie Burden did an interview that I urge everyone to go and check out with Dave Ramsden. He says, look, inflation is going to get much worse from here. And you can see that 10-year yield at 1.743. So there's nowhere to hide, maybe yen, maybe dollar, and that's seeing a rally. Now, a London-based startup that makes small modular units to capture carbon emissions has raised $150 million from investors, including Chevron, Saudi Aramco, and Samsung. Carbon Clean Solutions has tested its technology at more than 40 sites around the world and says it can capture as much as 97% of carbon dioxide released by steel and cement factories. Well, Anuruddha Sharma, the Chief Executive Officer of Carbon Clean Solutions, joins us now. Great to have you on the program. Thank you so much for coming in. When you look at the technology, and actually the challenges going forward? What do you need to make this even better? Is it 100% foolproof at the moment?
Well, I would say, look, we're getting there. We're already there 97% of the way. We've already demonstrated the technology at 40 sites. And with this investment round coming from major investors like Chevron, Saudi Aramco, Samsung, existing investors like Cemex, Equinor, I think this actually speaks really, really highly about the technology and what it needs to do to actually go out and decarbonize all these industrial sites out there.
From a branding perspective, is it a bit of a complication to have big oil backing you guys?
I wouldn't say so, to be honest. Look, I mean, if you're a fireman, where would you go first? You would go to the biggest fire. So I think about this exactly the same way. These guys from oil and gas industry are working very, very hard to decarbonize them. They know that if they do not decarbonize right now, they will not have a business tomorrow. So I think it's a great opportunity out there.
Anuruddha, what happens to this? So you capture it, and then what happens to it?
Great question, Francine. So you can do a couple of things with carbon dioxide. You know, once you've extracted it from the smokestack of all these industrial emitters, you can either utilize the CO2, like we do in India. We produce a chemical which is used for producing carbon-neutral detergents. Or you could permanently lock it away underground. You can store it underground like natural gas was there for millions of years. So it's a permanent solution where you're removing the carbon dioxide and you're storing it there, you're locking it up there, and in the process decarbonizing these facilities.
So the technology's been around for a long time.
For a long time.
But the question is how you scale. So you've got the funding, you're 150 million. How do you scale from here?
Great question, Tom. So I think from our side, we're actually trying to make it simpler. And like Francine said, we're trying to make it modular, flexible, and scalable. I mean, think about EV revolution, right? What happened? You had one car, which was great. One EV, let's produce millions of these units out there. We're trying to do exactly the same thing. Have a standard, modular, replicable carbon capture plant that you can go out to a gigafactory and say, let's start mass producing. Bring the cost down, set the right standard, and then just start deploying it out there.
And I mean, there's one thing, and people will say, and this is a little bit like some of the, the bonds in carbon, is that given this technology, it doesn't really help with decarbonizing the world. Is you're basically still producing it and putting it down in the earth. What we need to hit the Paris targets is just try and pollute less.
Yeah.
Is this a question that you get often from investors?
Very, very often, to be honest. And I think, look, I said two things to that. One is we need everything we have in a portfolio to work, to decarbonize. I mean, IEA has been very, very clear. International Energy Agency has been very clear. Look at Paris commitments. You need to do everything possible out there and do it at 100 times faster than that. So I think that's just one thing. Second is, how do you decarbonize industrial processes? I mean, decarbonizing energy is easy. Shut down a coal-fired power plant, build a renewable-fired, a wind farm or a solar farm, and that's great. How do you decarbonize steel, cement, energy from waste, refining, petrochemicals? We need these things, at least in the short to medium term, and we need carbon capture to decarbonize these sites.
Okay, let me fold two questions into one. Where are you on funding now? How much runway do you have? And how do you make the case in countries like India or the US where there is no carbon pricing?
Great question. So I think as far as funding is concerned, so we've announced $150 million US. That should, I think that should be fine for next 3 to 4 years as we go forward. Also depends how fast we start scaling up, because the market is opening up. People are realizing the intrinsic value of carbon right now. To your second question about India and China, I think we need to get started from the utilization, bring the cost down, and then start scaling up the technology. So like I said, we already have a plant capturing CO2, converting it to chemical. 2 quarters back, we started a plant with Tata Steel, India's largest steel producer, decarbonizing the steel production, world's first of its kind. We will be announcing another project this quarter. So I think you need to get these experiences out there so that people start to understand and realize there is absolutely a value in producing clean products.
Anuruddha, thank you so much for joining us. Anuruddha Sharma there, the Chief Executive Officer of Carbon Clean Solutions, with a robust conversation, of course, what this entails going forward.
Okay, let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The Bank of England's Deputy Governor has told Bloomberg that the bank will have to raise interest rates further to control surging prices. Dave Ramsden also warns there is a risk that the UK's worst inflation crisis in decades will take longer to ease fully. That's as GDP unexpectedly contracted in March as consumers cut back their spending. Italian Prime Minister Mario Draghi says European companies can pay for gas in rubles without breaching sanctions, apparently dismissing EU guidance to the contrary. European companies have spent weeks working out if they can meet Russia's demand for ruble payments. EU officials have said they should keep paying in euros, but have not yet issued watertight written instructions. Cryptocurrencies are falling again today after a plunge in algorithmic stablecoin Terra USD triggered a flight from many popular digital tokens. Cryptos are nursing heavy losses for the week, with sentiment remaining fragile. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francis.
Laura, thank you. Let's check in then on the prices of Bitcoin, repairing some of the losses or regaining some of the losses. You did see it down almost 10%, in fact, more than 10% early in the session, currently just lower by 1.7%. It's currently closing in on 28,000. Of course, it's still, within that level, comfortably below 30,000. Ether is another one that was badly hit. It was double-digit losses early in the session, currently at 1,900. So clawing back some of those losses, down 6.5%, Francine.
Now, coming up, Boris Johnson promised to supercharge Britain by reducing regional inequality, but 2 years on, an exclusive analysis by Bloomberg shows things are going backwards. We'll bring you that story next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back, everyone. It's the open, and we're 53 minutes into the European trading day, and the markets are ugly. European stocks down 1.7%. We're seeing a sell-off across the board. Inflation, of course, the big concern. If you look at the only things rallying, it's the havens, including, of course, yen and dollar. Now, the UK economy unexpectedly shrank in March as a rising cost of living forced consumers to cut back on spending. GDP fell 0.1% from February, and there's been no shortage of talk about the so-called levelling up of the UK. Boris Johnson's goal to balance what many see as a two-track UK economy, London and the rest of the world, or the rest of the UK. And to coincide with the launch of Bloomberg's new UK website, that's the subject of today's Big Take. Joining us now is Bloomberg's Joe Mays, our UK government, Treasury and Brexit reporter. Joe, thank you so much for bringing this in. I mean, if you look at, it's ugly, right? We had some great analysis, and everyone thought that levelling up was basically making it more equal, and it hasn't really worked out like that.
Yes, the picture is that it's gone backwards since 2019.
Crazy.
And Boris Johnson is further away from his goal of closing the gap between London and the South East and the rest of the UK. I mean, he's had many challenges. There's been the pandemic, cost of living crisis, these GDP figures today, but it just shows how even with the whole power of the state directed towards a goal, you can still be falling further behind.
The map and the graphics are amazing. The beaten heart of London remains stronger than ever versus the north of England, many parts of the north of England. What else did you tease out from this analysis, Joe?
I think it's so interesting how direct levers the government could be pulling, such as spending on public services, transport, civil service employment around the UK, they haven't used those levers as much as they could have done. So still, London and the South East takes up its disproportionate share on those metrics, which is really quite surprising. Housing affordability has worsened basically everywhere in the UK, apart from in London and the South East. So yeah, on many of these metrics, the picture is really quite grim.
What can we learn of what will happen going forward? I mean, I guess the government is aware of this. Are they trying to make it better?
Well, there's basically a pretty big gap when it comes to the detailed solutions of how to fix these problems. We've had the initial government white paper on levelling up, but we haven't really seen anything more than that. There's people saying funding needs to be increased significantly. There needs to be more commitment in Whitehall to actually devolve power and resource away, and it just hasn't been happening.
Okay, Bloomberg's Joe Mays. Well worth checking that story out on bloomberg.co.uk. Let's check in on the markets before we let you go. Pairing some of the earlier losses, but still down 1.8% across the benchmark. European stocks taking a hit as markets and investors reassess the inflationary outlook and the implications for central banks. Across your sectors, every single sector in the red. Crypto pairing some of its heavier losses as well, but still Bitcoin 27,800. That is it for the European market open. Surveillance Early Edition is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We figured out that a gas embargo would hit the industry of Germany badly, and it would really have a huge impact in terms of shutting down sites, unemployment, and of course an impact on our economy too.
As a matter of fact, most of the gas importers have already opened their accounts in rubles with Gazprom.
I think the problem is that the Federal Reserve has not been forceful enough in stating not just what their goal is, 2% inflation, but the means to achieve that goal.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks volatile in European trading after a red-hot U.S. CPI print. Markets fear the Fed has lost control of inflation. European gas prices surge again on lower flows from Ukraine. We're live from the G7 meeting in Germany as Finland's leaders say they support joining NATO. Plus, crypto crash. Terra leads the plunge of so-called stablecoins. Bitcoin falls further below $28,000. Now, let's check on the markets because that's really where everything's playing out. And we're seeing a sell-off across the board. When it comes to these European stocks, down 1.7%. Technology, again, down 2%. But actually, if you look at basic resources, they're down some 3%. So all sectors are on the downside. There seems to be a panic on the market about inflation, that a lot of the central banks actually lost control of inflation. Unclear what the ECB will do if we move to parity between euro and the dollar. Of course, this is the main conundrum for central banks, is do they risk plunging their economy in a recession to deal with inflation if inflation keeps on going up? But we're also seeing a huge sell-off in Bitcoin, 2770, and this is the picture that we are trying to understand. Is it crypto that's leading stocks lower? Is it just a general sell-off? We're seeing yen, of course, rally, and we're also seeing dollar rally as some of these havens are getting a bid. Then Russia oil revenue up 50% this year despite the boycott. This is according to the IEA. One other thing we're trying to figure out, and we'll get the European map, is whether Russia is now selling to Asia. We knew that it was much more difficult for some of these supplies because of the pipelines to be sold to China and other. You can see Russia there right at the back of the map on where these supplies go, but an interesting, of course, red headline crossing the Bloomberg terminal. So the UK is down some 2%, the DAX down 1.8%. Also interesting to look at what Mario Draghi, who's currently in DC, was talking about when it comes to gas. The two economies that are most dependent, of course, on Russian oil and gas is Germany, so the DAX and the FTSE MIB in Italy, and both of them are saying different things. So Mr. Draghi is saying maybe we could pay in rubles. That's against what the EU said. And then one of the German ministers saying that actually they can survive certainly on a shorter term without this Russian gas. Now let's get straight to a developing story. Also, Finland's highest ranking policymakers threw their weight behind an application to join NATO, expected within the coming days. Now for more, we're joined from the G7 meeting by Bloomberg's Europe reporter Maria Tadeo. So Maria, the fact that Finland is now deciding to join NATO, and we heard from the Prime Minister and the President there, what does it mean for the new leg in the war? How does Vladimir Putin take this?
Yes, Francine, and you know, usually we hate cliche expressions, but this really is history in the making. This decision by Finland, announced just an hour ago by the President of Finland, but also the Prime Minister, saying they've looked at the different options, they've assessed every security possibility for the country, and they now believe that Finland should join NATO. And by the way, they say it should be as soon as possible without delay. Now, of course, if you look at this in the bigger picture, this is a direct repercussion repercussion of the war in Ukraine. This is a complete watershed moment for Finland. It is undoing decades of foreign policy. But also, if you go back to the initial response of this war, Russia said it did not want to see NATO expansion, and this is exactly what it will get. This is Finland, but Sweden could come next. The other thing here, Francine, of course, is that at one point Finland was floated as a model for Ukraine, a country that would be so-called neutral. The Finnish, by the way, they hate that expression of neutrality. Nonetheless, we see now that Finland is not only far from providing a model for Ukraine, it's now joining NATO. So it's a complete U-turn of things here. It really is a spectacular turn of events over this. Now, the question going forward is how will Russia respond to this? Remember, there will be an interim period in which Finland applies for it, becomes a candidate country to the alliance, but it's not a full-fledged NATO member of it. It's not backed by Article 5, and I guess you could presume that on that interim period, they will ask allies to provide similar guarantees, while, of course, the paperwork gets done ahead of that NATO summit in Madrid at the end of June.
Great, thank you so much, Maria Tadeo, there with the very latest, of course, on this big developing story. Now, to look at the markets, we're joined by Anita Tana, head of EMEA equity sales at Barclays. Anita, thank you for joining us. What a day to come on to talk about the markets. I mean, I'm looking at everything, and it's just getting slammed. Copper dropping below $9,000 a ton as some of the metal demand concerns begin to mount. Why are markets so freaked out?
Yeah, so I think before we talk about why markets are freaked out today, it's worth thinking about the construct, the framework within which we're operating. 6 months ago, we were in a period of peak liquidity, peak multiples, and peak earnings, and the rates and inflation narrative and the aggression and the aggressive way in which that's played out in the last 6 months or so has clearly set us up for a difficult construct. Yeah. Now, yesterday, I think people were hoping for a weaker inflation print from the US, and actually that's coming a little bit stronger than expected, and it's got the market quite concerned about the rate of rate hikes, I guess, over the coming months. And I think that's again hit growth stocks, but also hit risk overall, as you quite rightly highlight.
So, Anita, is there a worry that actually there's a policy mistake coming from the Fed, also because they took that 75 basis points off the table?
Yeah, so policy mistakes, and I guess the broader narrative around the collective rate hikes, whether it be the Fed, whether it be the Bank of England, whether it be the ECB, are clearly the theme of the day. And for sure, the market is concerned about the pace at which the Fed is moving and the pace at which the Fed may need to move to get inflation under control. So that's absolutely the point in focus.
So, are you expecting more of a correction from this point? Again, we're unclear whether the ECB, for example, can hike rates, giving the proximity to Russia and the proximity to a possible recession. So is it currencies that will take the brunt of it, or are we going to see like parity on euro dollar?
Yeah, so I think the key here is that investors have been forced into a very, very narrow group of trades, right? Whether it be strength in the US dollar, whether it be certain sectors within the Euro stocks, so energy, for example, and whether it be underweights in other areas. There's consensus positioning all round, and the pace at which rates have moved, the pace at which inflation has moved, has pushed everyone into the same trade. So I think risk unwind is the theme of the day.
I mean, risk positioning, if everybody does the same thing, it makes me so nervous, Anita. Don't say that. No, you're absolutely right. I mean, you're seeing just this huge move. Look, copper dropping below $9,000 a ton. I guess, are we now pricing in a world recession? Or is the market pricing in certain parts of the market, everything going ugly?
I mean, recession is clearly the topic of the day. As you say, it all comes back to where we were and where we're going to as it pertains to rates, as it pertains to inflation, and as it pertains to getting that all under control. So for sure, that's going to be the topic of the day, and it's going to be discussed in markets. Europe in particular is the area where we see could be most exposed to a technical recession, just given the pressures for the consumer for Europe and the UK in particular. So they've had a lot to contend with, right? Whether it's checks running out from fiscal stimulus post-COVID, whether it's energy price inflation, whether it's food inflation, goods inflation. So this pressure that's coming through for the consumer in the UK and Europe, but also globally, is clearly the point and focus. And that's before we see the impact from rates.
Anita, stocks were cheap. So they're no longer cheap given I guess, the concerns we're facing, right?
Yeah. Yeah. So it depends which parts of the market you look at, right? So I think the ends of the market that have been hit particularly hard are those that were on very high multiples. So the growth stocks, essentially. And that derating has potentially got a long way to go. We've seen 12 years of fund flows going one way into one group of stocks, so that unwind could take quite a period of time.
Anita, today is also the day where we actually launch our UK website, so congratulations to everyone in BN and to everyone who's worked on the website. But Anita, we commissioned basically this huge study on leveling up and the fact that Boris Johnson has promised the UK to not only, create wealth in London, but in other parts of the country, and that hasn't really panned out. What does it mean for your level of exposure or appetite for UK stocks?
Yeah, so I think that's an interesting point. It depends which UK stocks you're looking at. If you're talking about FTSE 100 stocks, they've got significant exposure to overseas earnings, right? And within there, if we think sectorally, there's energy within there, basic resources within there, so traditionally seen as inflation hedges. But on the flip side of that, there's staples and there's pharma stocks, which are quite defensive. So the FTSE 100 has actually outperformed quite dramatically in the last 4 or 5 months or so. It's been one of our key recommendations. Now, what you're talking about is the potential impact for the consumer and the domestic economy. That's the FTSE 250 that has big gearing into that, and that's had huge underperformance thus far. And I guess the concern would be that that could continue.
Anita, thank you so much for joining us today. Anita Tana, their head of EMEA equity sales at Barclays. Coming up, as quickening inflation, supply chain snarls, and Europe's energy squeeze unnerve the market, French water and waste treatment giant Veolia seeks to reassure investors that they can ride out macro volatility. Well, we'll be joined by the COO, Estelle Brachlianoff, next. Plus, as Bloomberg UK launches, we'll also have a great conversation with the Legal and General Chief Executive, Nigel Wilson, and economist Jim O'Neill. That's coming up a little bit later, and this is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Veolia reported a jump in quarterly profit and reiterated its growth forecast for the year. That's following the acquisition of a large part of rival French utility Suez in January. Now, the water and waste treatment giant is confident it can ride out COVID resurgence in China and rising energy costs in Europe. Now, we're joined by Veolia's COO, Estelle Brachlianoff, who will take over the role of Chief Executive from July the 1st. So, Estelle, first of all, congratulations on, of course, a new appointment. Talk to me a little bit about some of the challenges that Veolia will have to face. How do you see the energy complex playing out?
I guess we've had a very good start to the year with very solid Q1 result, as you've mentioned, and the 7.6% growth in EBITDA, which I'm very happy to be having today delivered. And second good news before I talk about the challenges is really that the merger is really well underway with the combined team across the globe, and with Suez and Veolia merging together, and the first delivery of the synergies in line with our annual targets. And in terms of challenges, I guess we are quite a very resilient as well as very able to react type of company. In terms of inflation, it's obviously for us a focus of attention, but we are very well protected altogether, as we've seen in the first quarter.
So does that mean hedging? If it gets much worse, if we actually have an oil embargo between the EU and Russia, what does it mean for Veolia?
So the reason why I'm very confident about inflation, which is neutral or even slightly positive for Veolia, is a lot of our contracts are indexed. We've been able as well for the non-index contract to pass a very good price increase throughout the last few months in the US, in Europe as well. And in terms of energy, we are hedged. So we have 95% of all our supply for energy for the year, which is already bought. So security of supply for us is a key paramount, and it's been very, very important for us throughout the year, and we're very happy that this hedging policy was very paramount this year.
Estelle, when you look at Veolia being affected by the resurgence of COVID in China, how will that play out? And is it supply chain concerns that you have that's affecting a lot of other companies, or is it really more targeted to some of the areas in lockdown?
When I mentioned, the job Veolia does is actually supporting services and social services to usually local populations. So we are not at all a manufacturing company, for instance, which has a high dependency on supply chain and worldwide supply chain. So we are very multi-local in that respect, and that protects us from many of what's happening in the world today. So in China, we don't depend on anything but Chinese operators to serve Chinese needs to a large extent. Of course, we've seen some slowdown in the growth due to the lockdown in Shanghai, but that's pretty much it so far.
Talk to me a little bit about some of the other things that also you need to manage, which, Veolia is, for example, in charge of several district heating systems in Central and Eastern Europe. What does the ban on Russian coal mean? What does the relationship that the EU will have on Russia affect some of those contracts?
Very simple answer, we don't buy Russian coal, so we are not affected by that. And again, as I said, we've secured all the other sources of energy supply for the entirety of the year. And we are progressively as well moving to alternative fuel. And actually, we have an opportunity with all Veolia does to help with the security of energy supply in Europe and in the world. Because what we do as a business, part of our business, is to produce locally sourced, sustainable, affordable sources of energy and materials as well. Yeah. How do we do that? We produce biomethane, we produce alternative fuel, we produce materials from recycling electric car batteries, the methane we produce from a wastewater treatment plant or landfill gas. So as you can imagine, we are part of the solutions to this strategic need to basically get rid of importing fossil fuels.
So is that in preparation for a cut in Russian gas supplies?
Actually, today, again, we have everything hedged for the year. I'm thinking of the offers Veolia can offer to our customers. And, if we gather forces, we actually can speed up with delivering these locally sourced sources of energy, which we can produce in every single of our countries. And in a way, it enhances the need for our services across the globe.
Wonderful. Estelle Brachlianoff, thank you so much for joining us. Veolia's COO and incoming Chief Executive Officer. I have to say also with a great fashion sense, given we're both wearing black and white. Coming up, the earth shakes for Terra as a stablecoin proves to be anything but stable. We have a crypto update for you next. This is Bloomberg.
soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, stablecoins are failing to live up to their name amid a collapse in the algorithmic tokens. Cryptocurrencies have steadied this morning, but the woes of the Terra USD stablecoin actually triggered a flight from many popular digital tokens. Now, for more on all of this, we're joined by Bloomberg's Emily Nicole. Emily is our crypto czar. I love speaking to you because you make us so much smarter, Emily, on what exactly is going on. I mean, I just look at it and go, wow, what is going on? Bitcoin, below 28,000. What has been going on in the crypto space in the last couple of days?
So we've seen a bit of action all over the place. Initially, it's been a major slide for Bitcoin, especially today. It's gone down to its lowest point for quite a while. And that's something that it doesn't usually do, actually. Going down to a low past the year before has only ever happened once before, so this is quite a big deal.
It feels different as well, isn't it? It feels like a slide that I don't know if it's trying to find a bottom, or I'm not sure whether it's crypto that's giving momentum to stocks or the other way around.
Yeah, usually there's a bit of a back and forth between Bitcoin and the tech stocks. We've been seeing increasingly strong correlations between Bitcoin and tech stocks over the last few months, indeed. And so that argument of Bitcoin as inflation hedge isn't really working out so much at the moment. But this week in particular, it's been unique because we've seen a knock on to stable coins as well, like you mentioned before. Coins that are meant to hold a strong peg to the dollar normally. So they're meant to be flat value, not volatile, a safe store of wealth when you don't want to leave the crypto ecosystem, but you want to be able to make sure your money stays at the value you want it at. And those have been falling off their pegs left, right and center, with some of the biggest stable coins in the ecosystem falling as low as 20 cents at one point yesterday. So it's really big damage.
So, Emily, does it recuperate from this damage, or are there any ramifications, longer term once we get through this?
So if we look at the one that fell really, really low yesterday, that would be UST, which is backed by Terra. Yeah. That one, the founders are now trying to scramble to find outside funding to basically bring that peg back up to the dollar. The way that stablecoin is managed is using a combination of algorithms and trading with another token on its network called Luna, and that usually tries to keep its peg done using basically complex maths at $1 rather than having a bunch of real dollars behind it. Unfortunately, because that process hasn't worked out for them now, they're now trying to find real dollars to back it up. They're only seeking about 1.5 billion at the moment is what we're understanding. But to be honest, what we're hearing is that that's not even going to be enough. They're going to need to get up way more than that to get it back up to $1.
So where are they looking for funding? I mean, and if you're a retail investor, you're not protected, right? Or does it depend on the jurisdiction?
you're not protected pretty much anywhere. I don't think there's any rules anywhere at the moment that would protect people from stablecoin investment. The UK is actually one of the very few places where they've put out rules that may come into force in a year or two that would seek to provide some protection for stablecoin issuers. But at the moment, anyway, there's no protections at all. Just like with the rest of crypto, any money you put in is entirely at your risk. In terms of whether or not where they're looking for that money, for that dollar, they're going to, the who's who of crypto. Any investor that's made its name is pretty much on the list, is what we're hearing. A few of those have already said, no, we're not interested in participating. Yeah. So, time will tell as to whether or not they're going to be able to get that 1.5 billion they're seeking.
How many calls do you think Mike Novogratz got?
Probably a lot with his lunar tattoo.
Probably a lot. We need a picture of the lunar tattoo, actually. Emily, thank you, as always, for making us smarter on cryptocurrencies. Now, coming up, our flagship new Bloomberg UK site has launched. It was launch day today. We talk UK growth, we talk economics, we talk politics next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and for the next 30 minutes, we're going to be focusing in on the UK economy, on UK finance, and UK politics, because Bloomberg UK at Bloomberg UK on Twitter or Bloomberg #UK on the website, has launched today, and our 500-strong newsroom here in London will keep you updated on all of the news you need to know on the City of London and beyond. Now, there's also been no shortage of talk about the so-called levelling up of the UK. Boris Johnson has called it the defining mission of his government from day one. The goal, simply to balance what many see as a two-track UK economy, London and all of the rest. What we've heard less about, of course, is how successful it's been and even how to measure that success. Well, Bloomberg has crunched the numbers and broken down how well the UK has been levelling up since 2019. Now, let's look at three of our metrics: salaries, home affordability, and productivity. Of all UK constituencies, we have a great map. 91% are doing worse for salaries in the UK. Home affordability is worse in 88% of constituencies since 2019. Meanwhile, productivity has improved in about half of UK constituencies. Well, joining us now for more is our news director, David Merritt, also my co-anchor of our new podcast focused on, well, London and the UK. But Dave, I'm excited about this. First of all, congratulations to you and the team on a successful UK website launch. I mean, this is huge. The levelling up we were promised is just not working in the UK.
That's right, you know, and this has been a government slogan, obviously, now for several years, and no one's actually dug into the data with the depth and breadth that Bloomberg is publishing this morning. We've been spending months looking across the UK around 12 different metrics. You mentioned some of them there, and the results, when you compare where we are now to 2019, makes some pretty alarming reading if you are the Prime Minister. The salary gap, it's widening actually in 9 out of 10 constituencies. Home affordability, so crucial obviously for everyday people, that's getting worse nearly everywhere. And public spending, which we haven't mentioned, per head, that was supposed to be the kind of the lever to level up. That's actually fallen behind London in every region of England.
I mean, this is terrible for people that actually don't live in London. How much of this is the government not doing enough, and how much of it is it outside forces, inflation, energy crisis, and the cost of living going up?
Well, of course, you know, the government will say, look, we've had a pandemic, we've had
the government will say, not us.
Yeah, not our fault, a huge economic shock. But of course, that doesn't explain the disparity around, you know, around the country. Really, the gap is widening between London and these areas of Britain that were promised a New Deal under this government. And of course, there are these other factors like Brexit sitting in the background. You know, the Office for Budget Responsibility is saying that's going to shave various percentage points of GDP growth in the long term and is contributing to the cost of living crisis. And of course, it's this government who insisted on pushing Brexit through. And we know it's feeding back into inflation, which, as we've seen from the GDP numbers this morning, is contributing to a contraction in the economy. So it's not very easy for the government to step back and say not all of this is any of our doing.
Dave, I'm really excited about our UK launch. So this is a new website, and it's basically getting the power of the Bloomberg and trying to explain for a UK audience or an international audience interested in all UK stories. What do we have on today?
That's right, exactly. So, you know, we've got our big analysis of the UK economy there, and we're really zeroing in on all those subjects dear to our hearts here at Bloomberg. You know, finance, the City of London. We've got a great interview with Alison Rose, the Chief Executive of NatWest, talking about the fraud, the pandemic levels of fraud she talked about in the economy. We've got an interview with policymakers at the Bank of England, talking about the needs for interest rates to go up. We've got a great video that you were involved in this with the Soho House founder, Nick Jones, talking about his business. That's our Bloomberg Breakfast series. So a real wealth of data about and information about business, finance here in Britain.
Yeah, breaking news. Dave and I also have a podcast where we spend a lot of time talking about Paddington. And this is like a poll on social media. Go and check out Dave Merritt, at Dave Merritt on Twitter, and tell me what you think about his picture. A, he's worth a follow. And the picture is just
name
gold.
that person in one, basically, yeah. Prizes.
Twitter gold. Thanks to our David Merritt, our news director. Now let's get straight, thank you, David. Let's get straight to the Bloomberg First Word News, focusing on the UK today. And here's Leanne Gerrans. Hi, Leanne.
Hi, Francine, and thank you. The Bank of England's Deputy Governor has told Bloomberg that the bank will have to raise interest rates further to control surging prices. David Ramsden also warns there is a risk that the UK's worst inflation crisis in decades will take longer to ease fully. Now, the UK's biggest supermarket is planning to get on the work-from-home trend. Tesco has teamed up with IWG, the flexible office company that owns the Regis brand, to convert excess supermarket space workplace into a work hub. IWG has called the shift to hybrid working irreversible and plans to add 1,000 new locations to its wider network in 2022. And Brexit hamstrung the UK's efforts to create a thriving crypto industry, but the sector may be the country's ticket to regaining lost ground. That is the view of more than half a dozen executives of digital asset companies. They're expressing cautious optimism about the UK's prospects. They cite a string of recent initiatives to stem an exodus of crypto firms. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. You could work from a supermarket, Francine.
There you go, Leanne. The news you can use right here on Bloomberg Surveillance Early Edition with Leanne Gerrans. Thank you. Let's get more about one of our top stories this morning. As we mentioned, the UK economy unexpectedly contracting in March as the cost of living squeeze saw consumers cut back on spending. Well, to dig a little deeper, we're joined by our UK economy reporter, Lizzie Burden, who also had this great, fantastic interview with Dave Ramsden that moved pounds. So I'm really excited about that. But Lizzie, first of all, let's talk about UK GDP. What did they tell us?
Well, we had this unexpected contraction of 0.1% in March, which means for the quarter you had growth of 0.8%. If you look back at the retail sales data, they showed that consumer spending was struggling to bear up against surging inflation. So Bloomberg Economics reckons in the second quarter you're going to see a contraction, but not in the third, which means the UK will narrowly avoid a technical recession. But it really does underscore the headache for the BOE because they've got to manage surging inflation, but also you're seeing this weight on the recovery.
Yeah, technical recession. I mean, it's always like a technical recession, so don't worry about it. But then the cost of living is an absolute nightmare. Now, you had a great interview with the BOE deputy governor, and basically he's really worried about inflation.
He is. He says that we constantly underestimate the labour market and its resilience, which means we'll get upside risks on inflation, which means we need further tightening from the BOE. He says in June it's going to be an opportunity to take stock, so it'll be interesting to see how he votes. We asked him about the market curve, which of course sees rates rising to 2.5% by 2023. He refused to endorse or refute it, but he says that the bank's gloomy forecasts, which are based on that market curve, are not in themselves going to bring about a recession by making people more negative. He says people will understand the bank isn't talking down the economy.
I mean, do people understand? I certainly know that on the back of that interview, sterling moved.
It did. I think that, well, as Dave Ramsden said himself, people can feel this inflation, and it's really painful, even mostly for the poorest households. So that's the thing.
Lizzie, thanks so much. Lizzie Burden there with the very latest on the UK economy. And you can see actually I think we were just looking at sterling there, and you can see it move on the back of this huge move overall in currencies. We're possibly looking at parity between euro and dollar. You can see sterling there 129.93. Now, coming up, we speak with the former UK Government Minister Jim O'Neill and the Legal and General Chief Executive Officer Nigel Wilson on the UK economy. We'll talk levelling up. Maybe we'll talk a bit of football. I feel like that'll come up with Jim, maybe. That's coming up next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In crypto, you have a world of young that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and we're focusing in on the UK today as Bloomberg UK launches. It's on Twitter and it's also on our website. Now, as we've been discussing, the UK economy unexpectedly contracted in March as a cost of living squeeze forced consumers to cut back on spending. It's throwing doubt on the Bank of England's ability to keep hiking interest rates and piling pressure on the Prime Minister Boris Johnson's government to respond. Now, we're joined by Nigel Wilson, Chief Executive Officer of Legal & General, who's led the investment of over £30 billion in the levelling up the UK's regional economies, and Lord Jim O'Neill, he's Vice Chair of the Northern Powerhouse Partnership and former Commercial Secretary to the Treasury. So thank you both for joining us on a robust conversation. First of all, I'm extremely pleased that you two know each other, because I'm sure you've had some robust arguments on what it takes for the UK to level up. But Nigel, we have actually tried to measure the success of the government. We have this great data that's, proprietary to Bloomberg, and it just hasn't worked out. If you look at constituencies, a lot of them are worse off. House is not affordable. What should the government now do to get back on track?
Well, I think they've spent a long time theorising what levelling up means, when actually we need to invest at a huge scale, and it shouldn't just be Legal & General, who's been on this levelling up journey for over a decade now, and working with Jim and his colleagues up in the north. We've just underinvested, so it's no surprise that your data is telling us exactly what we are experiencing out there, that there's just massive structural underinvestment in the UK, and that's what we need to sort out.
Yeah, Jim, I mean, first of all, do you agree with that? And two, if you do agree with that, why hasn't the UK government spent more? I mean, they're blaming, of course, inflation, the cost of living on external factors. What could they have done to make levelling up a reality?
So first of all, the very idea that Nigel and I would argue about anything is like, that kind of a bit of a blow to start with. But listen, I think it's very complicated to give you a quick answer. I mean, the most important thing is, all of the North is not just one place. And linked to what Nigel said about how he's been on it for 10 years, there are some small parts of the North which I bet your data doesn't show is doing so badly. I think central Manchester and Leeds in particular, and some of the already reasonably wealthy suburbs have done pretty well the past 5 years, probably even better than London. But in general, it is a fair statement. And it's because the governments have been completely half-hearted and far too focused on the PR of this agenda. And given the scale of where these challenges come from, which go back to when Nigel and I were in our shorts, the challenge to address this is enormous. It's more important than anything else to do with UK economic policy. And so you can't just play at it. You're going to be really serious.
Jim, let me just break down some of our metrics, right, because we have this research that basically Bloomberg News has done. So these are our metrics: salaries, home affordability, and productivity. And of all UK constituencies, 91% are doing worse for salaries in the UK. I think we have that graphic that we can bring up again. Home affordability is worse in 88% of constituencies since 2019. And on a third metric, productivity, it's improved in about half of UK constituencies. Now, I didn't mean to say that, you two were arguing, but Jim, is there something that the UK government should do now? Actually, I wish you were, to level up, to make this better.
Listen, I think, the levelling up, the much delayed levelling up white paper, all 300 odd pages of it, is kind of like a PhD thesis in what one would write about what you need to do. Apart from, crucially, education, where, frankly, it's pathetic. But a lot of it in there, and it has all the hallmarks of Andy Haldane, who was heavily involved in it, is actually quite substantive. But as we see with this government, and frankly, another part of the problem of life here and elsewhere with many governments of the time, what they talk about and what they actually do, there is an enormous gap between. And so they have to need to be really serious about delivering on what the Levelling Up White Paper involves, and that requires massive devolution. We've only just started it in the best places like Greater Manchester, but we need huge amounts of devolved responsibility, much more infrastructure spending that Nigel's one of the, well, not one of, the leading pioneer in the private sector. We need huge efforts on education and skills, and we need a lot of people in these local areas to stop thinking life owes them because of some time in the past when they had a great industrial base, and try and get something that makes them special for the new complex way the world is evolving. And you know, these are big, big challenges, but everybody's got to be really serious about them if they really want to have a chance of succeeding.
Nigel?
No, it's a massive investment required, and we've worked with a number of different areas, but we've only worked with a sample. And Jim's talked about Manchester. We've done outstanding work in Manchester. If you went to Alderley Park, which we bought at AstraZeneca, that's got 250 startups on, 2,500 new jobs in that area. Leeds, which I'm in on Tuesday, and I'm in Birmingham on Monday. There's pockets of fantastic work going on. The Andy Streets and the Tom Reardons of this world are showing real leadership in Leeds and Birmingham, and indeed in Manchester, Andy Burnham and others. So it's not political in that sense. It's actually people, and you have to work hard to get and not be entitled to stuff. And there's too much entitlement going on, and people remembering an historic
But the
past.
infrastructure spending, I mean, that's not entitlement. It's just the government not spending enough on infrastructure that some of those regions need.
Yeah, I agree. And I think there's been crowding out rather than crowding in. You know, I think, you know, we should have had intra-city expenditure, not stuff like HS2, which is, in my view, and I don't know what Jim's view is on it, just a huge waste of money. It would have been better off to give that 100 billion and give Manchester 10 and Birmingham 10 and Leeds 10 billion to actually improve their infrastructure. And that would have been a much better way to deliver economic growth, and then crowd in money from people like ourselves, because we could easily spend another 30 billion. It's not we're constrained by the projects, not by the capital. And that's a lot about ambition at a local level being coupled with support from the central government. And at the moment, the outcome is a very lengthy report, parts of it which are excellently well written, but it's, you know, our version of that document's about 20 pages, but it's 20 pages of what should be done, not actually, you know, the history of what has not been done.
Nigel, thanks so much. Nigel Wilson, Chief Executive Officer of Legal & General, Jim O'Neill, Vice Chair of the Northern Powerhouse Partnership. Both stay with us. They were way too polite, and they've got far along too well. So next up, they're going to have a fight. Coming up, we continue the conversation on the UK economy with the former UK Government Minister, Jim O'Neill, and Legal & General Chief Executive Nigel Wilson. Both of them stay along. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm feeling okay about the future. I'm very conscious of the challenges that are facing people, but I think there is a lot of resilience in the banking sector and in the corporate world that can help. There is a bit of a buffer there that can support. So I think we just need to navigate that, and hopefully inflation will settle down. I do think things are exacerbated right now because of the invasion of Ukraine and what that's doing to supply chains and the geopolitical impacts. But I think it's just really important to try and give good advice, sensible advice, and plan sensibly.
Well, that was the NatWest Chief Executive, Alison Rose, speaking to me on the latest episodes of Leaders with LACWA. Now let's get back to our all-star panel. Nigel Wilson, Chief Executive of Legal & General, and Jim O'Neill, Vice Chair of the Northern Powerhouse Partnership, both still with us. We were talking about leveling up and how, of course, this Bloomberg data says that it's not as good as it could have been, and that's probably a euphemism. Nigel, you also reminded me in the break that this is not only the politicians' fault, it's also private money not getting to the places where it should be. But working from home, has it change that? Because it's actually cheaper to hire someone that doesn't live in London.
No, I don't think anything's changed in one sense. The government hasn't been doing very much. They've got a plan to start engagement. They're behind their plan. We're executing everything we thought we could execute. And I think you'll see in the next few months, we have a few very big announcements about what we're going to do in further cities across the UK. But we're still slightly a lone voice, and we need more growth equity, we need more infrastructure spend by the government, and we need more private sector firms stepping up to invest in there. But we also need the universities stepping up and actually just not sitting there waiting for things to happen, being very proactive and getting out and investing and trying to become like MIT, Harvard, and Stanford, which are issues we talked about before.
And Jim, this is, on education, then I want to get back to maybe healthcare. But Jim, this is something that you've been trying to, do a lot more for. It's universities in the north.
Yeah. What Nigel's just touched on there is very dear to my heart. You will see in the next couple of days, possibly over the weekend on Monday, an announcement about the so-called first close of Northern Gritstone, which I am the chair of. It's a very new, really exciting project, right in the core of everything we're talking about, which is a patient capital vehicle, not a fund, which is going to be devoted towards investing in startups coming out of northern universities. So it's very ambitious, but it's to try and be directly getting more great ideas coming out of northern universities to end up doing for their locations what MIT has helped do for Boston, as Nigel touched on, but also to be a cog in the wheel of opening up all of this, what has been a vicious circle, starting to become a virtuous one. And it's one of the most important and certainly most interesting things I've done in my career, and I'm very excited about it.
And Jim, congratulations on, of course, this tremendous effort. Does this change the way that the Bank of England should look at things? Leveling up.
In the process of getting our first close, that in itself is hugely revealing about the very strange nature of the UK investment world. You know, the UK prides itself on this huge financial sector, but sadly, and Nigel again is a pioneer, there are so few institutional investors that will truly focus on what Nigel and I would both probably describe as patient capital. They are obsessed with liquidity and very conventional, easy ways to superficially at least do things. And none of them, or not many of them, are genuine risk takers. And we're really grateful to the small number of institutional investors that are anchoring Gritstone along with others, because without them we couldn't do it. But there needs to be a huge increase in the way UK institutional investors think about these things.
Yeah.
And the Bank of England and the Treasury, frankly, need to force them to do it, because this is at the core of the UK productivity problem.
Yeah. Okay, thank you both for a robust conversation. Nigel Wilson, Chief Executive Officer of Legal & General, Jim O'Neill, Vice Chair of the Northern Powerhouse Partnership. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons will be in New York. Anna Edwards in London. Huge moves when it comes to the markets. We're seeing definitely a risk-off mood. If you look at what exactly is going on, stocks still tumbling amongst inflation worries. This is the biggest thing that we really need to keep an eye on. Stubborn inflation in the world's biggest economy, bolstering the case for more aggressive monetary tightening by the Fed. And we're seeing a rally in dollar, a rally in yen as people go to safe havens. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It could be a volatile period in the short term, of course, because there are still many growth challenges ahead.
But this cycle looks quite different.
We have seen a lot of froth come out of the market.
We're not seeing full panic, as I would call it.
When fear abounds is when you look to take advantage of that.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, May 12th. Our top stories today. Cryptocurrencies keep dropping following the collapse of the Terra USD stablecoin. European stocks are down and Wall Street's sell-off is set to resume. Shares of Disney are lower. Streaming subscriptions were better than expected, but the entertainment giant tempers its outlook for the rest of the fiscal year. And Boris Johnson's flagship plan to fix the UK is in trouble. The Prime Minister promised to reduce regional inequalities, but things are going backwards. We bring you exclusive Bloomberg analysis. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And European markets dropping, US futures dropping, Kaylee, not to mention cryptos dropping.
Yeah, everything seems to be dropping, Anna. That certainly was true in Asia overnight, where pretty much every single regional benchmark was lower on the day. The MSCI Asia Pacific Index as a whole falling about 1.7%. And your real underperformer, maybe no surprise, given what we have seen in recent days, was technology. The Hang Seng Tech Index falling 3.8% in the overnight session. There is one individual stock I want to point to in particular, though, and that would be SoftBank, which, of course, has the Vision Fund, which posted a record loss of $20.4 billion in the latest quarter. The reason why is a lot of those technology names that have gone sour, the likes of DD Global, Alibaba, Coupang, all of that weighing on that stock, which fell about 8% in Japan overnight. Speaking of Japan, I would point out one interesting thing happening in the FX space today, and that is that we are seeing a substantially stronger Japanese yen, stronger against the dollar by a full percentage point. We're back down around 128.62 at the moment. It is the only outperformer against the dollar in both G10 and in Asia. Interesting that it's catching a bit of a haven bid today, Matt, because that isn't what we have seen as of late.
Yeah, that is interesting because I just noticed that the Bloomberg Dollar Index itself is gaining right now. You can see S&P futures down about 0.2%. So investors are certainly selling risk assets, but they're buying bonds. That pushes the yield down to 2.84%. They're buying the Bloomberg Dollar Index, as Kaylee said, against everything except for the yen, and that traditionally is considered a safe haven, even if we haven't seen it acting that way of late. Bitcoin is certainly not seen as a safe haven. Right now, down almost 3%, well below 30,000 to $27,640. And the question is, how much does this have to do with the collapse of the algorithmic stablecoin Terra USD? We'll be talking about that throughout the program. Anna, what do you see in Europe?
Yeah, it's interesting, isn't it? How much is contagion between those crypto assets and how much is them just all responding to the same fundamental driver, if you like, and tighter rates. Let's have a look then, Matt, at Europe. And European equity markets are considerably weaker, down by more than 2% on European stocks. Beware, though, some of this is backward looking. Of course, some of this is pricing in the weakness that we saw on Wall Street yesterday, a concern around inflation, a concern around higher rates. We've got lower yields, though, on treasuries, lower yields on a lot of European debt. So maybe inflation concerns not front and center, growth concerns maybe moving more front and center, but no sectors in Europe are in positive territory today. We are considerably weaker here. Let's have a look at some of the other assets on the move for you, or within the equity space. I've got basic resource stocks, and here's where we see a lot of expression of that concern around global growth. We've got iron ore prices weaker, copper prices weaker, and so the stocks related to that go down. Here's a different story, though, the geopolitical risk attached to this particular commodity. This is the European natural gas benchmark. That particular price jumping just 12%, in just one day. So this is one one day's move, another substantial increase in that natural gas prices. We've seen flows from Russia through Ukraine actually moderating. Here's the euro, 104.29. With that dollar strength that Matt was talking about, and a bit of yen strength that Kaylee referenced, we're on parity watch when it comes to the euro, so just putting it in there just in case it happens. We're well away from it now, but 104.25 perhaps getting closer. And Siemens is in focus today, the German industrial giant, down by 6.5% after 170 years, winding down their Russian business. Also concerns about energy policy, of course, across Europe and what that would mean for the German economy. More on that a little bit later.
That's a long time to wind down a business. 170 years. Wow.
That's how long they've been there. Yes, they were winding it up for a long time.
I see.
But
Okay.
now
Got it.
the politics has changed. Let's talk about where we are on Russian assets. Then we've got Russian assets in focus once again, of course, because of war in Ukraine. And interesting to note that one of the reasons we're seeing energy policy being talked about so much in Europe right now is about Russian oil, reliance on Russian oil. We saw a 50% increase in Russian oil revenues year to date so far this year. And so that really underscoring the way that Russia is continuing to get that money in on the oil front. Although in the most recent month, Kaylee, that was falling. And that's when we've seen perhaps self-sanctioning and some parts of the world, including the US, stopping imports of Russian oil.
Yeah, but not China and India, which is why Russia is continuing to rake in that cash. Now let's take a look at what is ahead today. G7 foreign ministers will be gathering in Weissenhaus, Germany for a 2-day meeting. Then Biden will be hosting leaders of the ASEAN countries in Washington. On the economic data front, after yesterday's hot CPI, we'll get U.S. PPI data at 8:30 a.m. New York time. And finally, Treasury Secretary Janet Yellen will be testifying to a House panel at 10 a.m. New York time. I wonder, Matt, if she'll bring up stablecoins.
Yeah, absolutely. She's been talking about it lately. The U.S. Treasury has taken note, and cryptocurrencies falling really across the board after the collapse of Terra USD. That triggered an exodus from many popular digital tokens, although, as Anna pointed out, maybe the exodus from those popular digital tokens is what triggered the collapse. Bloomberg Markets Live editor Eddie Vanderwalt joins us now to talk about what could be kind of a vicious cycle here. We didn't see a lot of contagion yesterday, Eddie, but we certainly started to see it overnight and into today.
Yeah, absolutely, Matt. You know what? I've even heard some obituaries about Bitcoin being written yet again, even though this space has been through these series of volatilities a number of times now. As you say, we are seeing a little bit of a spread from, you know, the instability of the stable coins. But really, that's a small sector even of that market. It's the algorithmic stable coins that we're talking about. And they are the ones that are, you know, and particularly then Terra, that have seen really an attack and seeing a big drawdown. Now, if stable coins as a group become unstable, if we're talking about you know, if we're talking about some of the larger ones, then I think this would matter. But because we're only really talking about the algorithmic ones, I think Bitcoin can probably ride this out. This is normal high volatility in a highly volatile market in, you know, in a secular bear market. So I'm not overly surprised at the moves that we're seeing.
Okay, so this starts with Terra USD, or it starts with the Fed and tighter policy, but it starts somewhere. And but is it a concern then that if we see it move on to Tether, for example, annoying that they sound so similar but are quite different, and then that would be taken much more seriously than by the market, because that has actually dropped a little from its peg.
Yeah, and look, Tether is a big entity. At the moment in Terra, you know, even at its peak, Terra was something like $18 billion US. The top two, Tether, you know, the top two coins, the top two stable coins make up $130 billion US, and they hold real assets. They hold assets, you know, that are linked to the real economy. They hold bonds. A lot of them. We don't know exactly what is, you know, in the biggest stable coins, but we do know that there are some bonds there. So if they start selling en masse to protect a peg, yes, there could be contagion. And I think the Fed has flagged that possibility before.
Yep, Tether right now trading around 98 cents, so not, in fact, at $1. Eddie Vanderwald of Bloomberg Markets Live, thank you so much. Let's get to corporate earnings now. Disney reported results that showed its parks are back while avoiding a Netflix nightmare. But CEO Bob Chapek cautioned on challenges to the outlook. Let's get more with Bloomberg's Laura Wright. So, Laura, did Disney Plus give stock bulls something to cheer for, considering Disney is trading at its lowest level since back in 2020?
We'll come on to the stock price in a moment, Kaylee, but yes, it did give the bulls something to cheer for. An addition of 8 million subscribers almost for Disney Plus last quarter, taking the total number of Disney Plus subscribers to just shy of 138 million. But if you are to total all of Disney's online content offering subscribers across Disney Plus, ESPN Plus, and Hulu, that number becomes 205 million. So the gap is narrowing between Disney Plus and Netflix. The price point for Disney Plus, it's competitive, less than $8 a month, and it's about to become even more competitive with the launch of an advertising service similar to what we saw from Netflix last quarter. Now, the cost of content is heavy. Disney's direct-to-consumer business lost almost $900 million last quarter, double from the same period a year ago. But that said, Disney can fund its future vision of growth with its profitable legacy businesses of the parks and its traditional TV business. But this raises the broader question of those former pandemic winners. Netflix losing 200,000 subscribers last quarter, down 70%. Peloton down 65%, hemorrhaging cash, the perils of a hardware business. Zoom, can it compete with Microsoft, the return to office? For Disney, it's the unknown macro headwind. What impact will that have on discretionary spending and continued rolling lockdowns in China?
Another pandemic darling, really until like the day of its IPO, was Rivian. Laura, yesterday Volkswagen announced they're going to bring back the International Scout brand in the U.S., which viewers outside of America won't know, but it's going to be an electric competitor to the Rivian. What do we hear from the Normal Illinois startup yesterday?
Well, while Rivian is trading up in the pre-market, this is a stock that has fallen 80% year to date, even worse than those former pandemic winners, which we just discussed. But what's going to happen now, Matt Miller? I'm going to turn into Bloomberg's Ed Ludlow, our colleague based in San Francisco, who's conducted some excellent coverage of Rivian. So now that I'm Ed Ludlow and I'm not wearing glasses, what I can tell you is that Rivian, they've reaffirmed their delivery target of 25,000 vehicles for 2022. It was a miss on revenue. The company's still burning through cash while pursuing growth. Elevated supply chain costs, logistics, that's common across the industry, although they think the worst of the semiconductor crunch is over. Interestingly, Amazon, the second largest shareholder, and Amazon has an order for 100,000 delivery trucks. They want to see 10% of those this year. But overall, with the EV industry, we know it will have succeeded the day that Matt Miller has an electric SUV. Forget the financial models, that's the benchmark.
I'll lend you the glasses. It's like Ed Ludlow's in the room. Laura, thank you very much. Bloomberg's Laura Wright with the latest on Disney and Rivian. Now, back to the serious business of European politics at this time. G7 foreign ministers are gathered in Germany to coordinate their response against Russia's invasion of Ukraine. Europe's energy woes are likely to be top of the agenda. For more, we're joined now by from the G7 meeting by Bloomberg's European correspondent Maria Tadeo. And clearly, the news out of Finland, really important to note, that they're ongoing with their efforts to join NATO, getting further high-level support there. I'm sure that will be discussed, but front and center, I'm sure, for these ministers is energy policy.
It will be. And Anna, if we could just take a moment to look at Finland. I mean, this is a spectacular turn of events. This is a country that now says we openly want to enter NATO. They have officially applied for this. Both the Prime Minister and the President of the country saying we've looked at every possibility now for our security in our country, and we believe in the face of Russian aggression, it really is NATO. And for me, this is an incredible moment. I mean, it is a watershed moment of defense policy in Europe. They're undoing decades of foreign policy when it comes to Russia. But also remember, at the start of this crisis, before the war, Finland was floated as a model for Ukraine. That Finlandization, that neutral status, which, by the way, Finns dislike that expression. Well, now what do you have? Finland joining NATO. Now, when it comes to this meeting in particular that will be happening today in Germany, of course, the G7 foreign ministers will be attending it, but also the Ukrainian foreign minister, Dmytro Kuleba, will be here in person. We know their demands. We know what they'll ask for. This is about financial help. Ukraine is bleeding cash. They say that on a monthly basis, they need from $5 to $7 billion, and that's just to cover basic expenses. It's about the weapons too, but in particular, when it comes to the French and the Germans assisting this meeting today, the Ukrainians are going to float once again their EU membership. They've made it clear, okay, we've had a reality check on NATO, but what about joining the EU?
All right, Bloomberg's Maria Tadeo at the G7 meeting in Germany, the northern shores of Germany. Thank you so much. Now, the Senate has added a third nominee of President Biden to the Federal Reserve Board down in Washington. Lawmakers confirmed economist Philip Jefferson as a Fed governor yesterday. And today, Senate Democrats say they expect to vote to confirm Jerome Powell to a second term as Fed chair, because yes, he hasn't actually been confirmed yet. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. And Jack, we know what Washington wants this Federal Reserve to do, and that is rein in inflation.
Yes, and that's one reason that we're on to the slightly less controversial part of Biden's nominees for this. Philip Jefferson actually was confirmed in a 91-7 vote. He was somebody with a lot of bipartisan support. He did emphasize the importance of reining in inflation. And as you mentioned, today is supposed to be the Senate vote before they leave for the week on Jerome Powell. These two are a lot more bipartisan and less controversial than, say, the Lisa Cook confirmation, which needed the vice president's tie-breaking vote to get her across the board on Tuesday. Obviously, we saw Sarah Bloom Raskin withdraw her nomination. They're working on the replacement. Michael Barr is supposed to get a confirmation hearing in committee on May 19th. So obviously, it's a major point of focus for President Biden. He has talked about how inflation is his #1 domestic priority lately, and also, despite all the back and forth on legislation that could address that, he has said it really is primarily up to the Fed's actions as well as the international supply chain issues, the Russian invasion of Ukraine. So while a lot of the political fights may be happening over tax policy in Congress and exactly what the president wants to do, this is where the real focus is. And as for Philip Jefferson and Jerome Powell, these are two of the easier votes for Biden to get across the Senate.
Jack, thanks very much for the update. Jack Fitzpatrick of Bloomberg Government joining us there from Washington. Coming up on this program, more on the collapse in crypto with Anthony Trenchev, co-founder of crypto lender Nexo. Really interesting to get his perspective on what we're seeing in these markets and the contagion risks within and beyond crypto. And Investec economist Sandra Horsfield joins us to talk about the global economy. We'll dive into the German risks around energy, also the UK economy in focus. Plus, check out our new site on all things UK growth, economics and politics. That's at bloomberg.com/UK. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Finally, you'll be able to find all of our UK stories in one place, wherever you are. They'll be data-driven,
fact-filled, unbiased journalism.
on social media, podcast, on TV, on radio.
Streaming, newsletters,
Print and digital. 2,700 journalists around the world.
finance, energy, economics. Bloomberg can be there in the format you need at the time of day that you need it.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television. I'm Matt Miller in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, we are looking at the world of stable coins, the world of crypto, the drop in Bitcoin, because Terra USD broke the buck in a big and horrid way over the past couple of days. It's an algorithmic stablecoin. Tether is considered a little bit more stable because it's actually asset-backed, although it hasn't really been audited. And it looks like it's come untethered today. We're down at 98 cents. It's the first time Tether has really broken the buck since March of last year, and it's actually been pretty stable throughout the entire pandemic. Ven Ram joins us, Bloomberg cross-asset strategist. And Ven, normally we focus on really plain vanilla things like fiat currencies and CPI numbers, the Fed reaction, but this crypto world is really getting a lot of attention. Is it showing any signs of contagion into the old school markets, the OG surveillance markets?
Morning, Matt. I don't think there's much of a spillover into the traditional currency markets. If you look at the non-dollar currencies, they are all falling today, and that's more got to do with the dollar story rather than anything happening with crypto. Of course, there is the drop in Tether raises all kinds of questions about stability and the store of value of crypto assets, but at the moment, it's all contained.
Okay, and sticking with FX markets then, we do see money into the dollar, into the yen, which marks a bit of a change, doesn't it, from recent haven status. We see money coming out of the pound. There's some politics on that. I see the Foreign Secretary saying that the UK has no choice but to act if the EU is not flexible. This to do with Northern Ireland and the politics there. What do you think is front and centre driving the pound? Is it just the dollar?
No, I think it's more than just the dollar story. I think what is happening is the real yield differentials are coming to haunt the pound. We have moved about 60 basis points in favor of the dollar in terms of the real yield differentials. And that's what is driving the pound lower, and that's what is driving the euro lower this year. Okay. And that's very much still a fundamental story. However, with the euro, there is a possibility that it could acquire a life of its own, and the euro plunging more than we have already seen.
Yeah, and we keep an eye out for parity. Not there yet, but we're watching. Ven, thank you very much. Ven Ram of Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog, MLIV Go. That's the function to use on your terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Keeping you up to date with news from around the world, here's the first word. Senate Democrats were blocked in an attempt to enshrine abortion rights into federal law. All Republicans and one Democrat, Joe Manchin of West Virginia, voted to keep a bill ensuring nationwide access to abortions from reaching the Senate floor. Senate Majority Leader Chuck Schumer said he wanted to put Republicans on record just as the Supreme Court is poised to overturn the landmark Roe v. Wade decision. In North Korea, Kim Jong-un has ordered all cities to be put under lockdown after the country reported its first COVID case. In the past, the country has always denied it had any cases, a claim that's been doubted by outside experts. The country also has refused vaccines from the outside world. Coming up, we'll get back to the sell-off in cryptocurrencies. Anthony Trenchev, co-founder of crypto lender Nexo, joins us. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu ramai sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Cryptocurrencies keep dropping following the collapse of the Terra USD stablecoin. Bitcoin fell below $26,000 before rebounding. Meanwhile, European stocks are down and Wall Street's sell-off looks set to resume. Shares of Disney are lower. Streaming subscriptions were better than expected, but the entertainment giant tempered its outlook for the rest of the fiscal year. And it will trim spending on movies and on TV shows. And Boris Johnson's flagship plan to fix the UK is in trouble. The Prime Minister promised to reduce regional inequalities, but things are going backwards. We bring you exclusive Bloomberg analysis. I'm Anna Edwards in London. Matt Miller and Kaylee Lyons with me in New York, of course. And Matt, European stocks are lower, buying bonds, buying the dollar, seeking havens on a day that seems to have a lot to worry about.
Yeah, absolutely. We do see futures down and some money going into bonds and going into the dollar, also going into the Japanese yen, as Kaylee was pointing out earlier. S&P futures off about 0.75%. You can see the 10-year yield coming down as investors buy the paper to 282, 283 right now. The Bloomberg Dollar Index is up, and actually the dollar is gaining against every major currency except for the yen, so that shows you that it's really a safe haven play. Meanwhile, you said Bitcoin dropping below 26,000 at one point, has rebounded a bit, but it's still down from, I think this price is from midnight, so still down from midnight, $27,730, and you really see it across the crypto space, though, Kaylee, as we just heard from Van Rom, maybe it's not showing any kind of contagion yet into, you know, plain vanilla traditional financial assets.
Yeah, but there certainly is contagion across all of the digital tokens and all of the stocks really that are tied to cryptocurrencies. You're definitely seeing that evident in pre-market trading this morning. Just take a look at Coinbase, of course, the big crypto exchange. It already has lost 59% of its value in just the last 5 sessions. It's lower by another 7.5% this morning, and you're seeing some big losses as well for the likes of MicroStrategy, another Bitcoin proxy stock, considering it holds it on its balance sheet. It's down a little more than 11%. There also are some more fundamental earnings stories out there. Of course, Disney, which Anna mentioned. On the good news front, you have parks doing really well, streamers, more subscribers than expected. The problem is that tempered outlook for the rest of the year, and that is weighing on the stock this morning. It's down about 5%. It already is trading at the levels last seen in May of 2020. The better story out there, though, is Rivian. Of course, it is the EV maker. It's been dealing with supply chain issues, but still holding firm to its guidance that it will deliver 25,000 vehicles this year. So that giving a little bit of a lift to the stock in early hours, up about 1.6% before the bell, Anna.
Kaylee, European equity markets really under pressure today, down by 2.3%. It's a little backward looking. We're reflecting nervousness about inflation in the US that weighed on Wall Street, of course, in yesterday's session. But adding on to that, concerns around growth. And so we see the basic resources sector, for example, really selling off here in Europe as there's concern around iron ore prices and copper prices. Some of those metals have been drifting lower. All that at a time where you see geopolitics pushing other parts of commodities higher. So natural gas prices in Europe up by another 13.5% on concern about Russia relations, of course. levels. Euro-dollar 104.31. We were talking about this with Ven Ram a little bit earlier. We're all watching to see whether we get any closer to parity on this one. A lot of dollar strength, a lot of yen buying, haven seeking going on in FX markets today, and other currencies pay the price. Also, the yield differentials he was talking about there. Siemens down by 7% for the German industrial giants. This is a business that's been in Russia for 170 years, now having to wind down those businesses and taking a financial hit as a result. Quick check on the Russian assets, and of course they are always in focus for us. Also want to mention that Russia has managed to increase the amount of oil revenue that it's secured year to date. It's up 50%. Of course, the early part of the year, first couple of months, maybe looked a lot more like last year geopolitically, and so you might expect that to be the case. But in the most recent month, actually that revenue line has been dropping as certain parts of the world have turned their back on Russian assets, and certainly Russian oil in some parts, Matt.
All right, so we'll continue to keep an eye on that, especially after comments from Mario Draghi seemingly indicating it would be okay to pay Russia with rubles for energy products. Let's get to crypto right now, cratering after the collapse of Terra USD. For more, we're joined by Anthony Trenchev. He is the co-founder and managing partner at Nexo. And Anthony, first off, we understand you were approached by Do Kwon and backers of Terra USD, asked for to support the currency. You declined. Tell us about it and why.
Well, there's only so much I can say about details of a rescue plan, which are still ongoing, and I don't want to intervene in any way. I do wish them best of luck. We made the decision at the board level that we didn't think prudent to get involved at this stage. If they come around with another proposal that we think makes better sense, we might reconsider, but for the time being, we're staying on the sidelines.
All right, so this collapse, and I realize it's an algorithmic stable coin and not the same as an asset-backed stable coin like Tether, but it's been described by some as possibly the Lehman moment for crypto. We're looking at billionaires from CZ to Mike Novogratz to Sam Bankman-Fried, who have lost 70, 80, 90% of their wealth in the last few weeks. Is it a concern for the industry at large?
I don't think it's a Lehman moment. You know, obviously not the prettiest of episodes, but we get one to two of those per year. You remember last year we had the China ban. The previous year, due to COVID, we had up to 50% declines. So this time, I think what is different is that you have a limited number of sellers. What I'm seeing on the Nexo platform, and we have close to 4 million retail users and a very sizable institutional clientele. I don't see them selling anyway the way they did in 2020 or 2021. I think the pressure that Bitcoin is seeing right now, it is the unwinding of the huge BTC reserves that the Terra Foundation had accumulated, and this is what is putting pressure on the market. I'm curious to see whether 25 is going to hold. If not, we might very well revisit 20, the previous all-time highs of the 2017-2018 bull run. But I think by then, at the very latest, large-scale buying will come in.
At what point do you think that would happen?
I think around 20, well, first of all, when the selling of this foundation stops, which, you know, from our estimates, there should be near. So $25,000 per Bitcoin or 20, worst case scenario, should be the turnaround points.
And we're not too far from that right now. 27,800 or so is where we sit at the moment. Anthony, it's not just those who hold these digital assets, us in financial news, who have noticed this. Regulators are taking note as well. The Fed mentioned stablecoins in its financial stability report earlier this week. Treasury Secretary Janet Yellen was talking about this on Capitol Hill. You have Senator Pat Toomey talking about stablecoins as well. What about the regulatory threat stemming from this episode?
Yeah, this is, to me, potentially the more midterm important thing than the short-term turmoil that we're seeing right now. Obviously, crypto and Bitcoin's opponents are going to make a case out of this, that, you know, one company failing or something like this is, you know, an example of the industry as such. That's why I've always advocated that, the good actors within the industry, we should go the extra mile, whether it's in KYC and AML considerations or just talking to the regulators and explaining exactly what we're doing and why this is useful, because it is a fragile industry, and we'll, ramp up our efforts to engage with the regulators even more than until this point, so that we can, potentially prevent unfavorable and unnecessarily stringent legislation.
Anthony, good morning to you. Can I just get some more clarity on the links between various crypto products, and just to get you to confirm what I think you were saying about weakness in Bitcoin? Do you see this as linked to efforts to prop up Terra USD then? So is there a link between what's happening with Luna and what's happening with Bitcoin at this point? Bitcoin at 27,790.
Yes, I think so. What appears to be the case is that the Luna Foundation is essentially propping up the price of USD, trying to reestablish the peg of the stablecoin to the dollar in this 1-to-1 ratio that they are aiming to be constantly at. This unfortunately has been breached, and what they are doing is selling Bitcoin for USD, essentially buying up USD, and they have a vast inventory of Bitcoin, but it is getting smaller by the hour. So this is the selling pressure in Bitcoin in particular, and sooner or later it is going to finish. And then, some of the institutional players that we're talking on a daily basis are waiting for that exact moment to come into and snatch up Bitcoin below 30,000.
Anthony, great to get some time with you. Really appreciate you joining us on such short notice. Anthony Trenchev there joining us of Nexo, and very interesting to see that exchange, that Nexo has not had any problems related to Terra USD. He says they had no exposure there. Be sure to tune into Bloomberg Crypto, by the way, Tuesdays at 1 p.m. Every week, Tuesdays at 1 p.m. New York time, 6 p.m. London time. Kaylee and I co-anchor that program dedicated to looking at the crypto world. Next week, we're going to hear from Joe Lubin, co-founder of Ethereum, and the founder of Consensus, and Kara Calvert, head of U.S. policy at Coinbase. Anna?
It's going to be fascinating conversations around crypto then for the week to come. Another geopolitical line just to mention as we go to a break here. North Korea may have fired a ballistic missile according to the Japanese Coast Guard. We're also seeing the Yonhap news agency over in Japan citing Joint Chiefs of Staff over in South Korea on the same line, saying that North Korea has fired a ballistic missile. We'll keep up to date with that. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. There has been no shortage of talk about the so-called levelling up of the UK. That was Prime Minister Boris Johnson's goal: balance what many see as a two-track UK economy, London and all the rest. And to coincide with the launch of Bloomberg's new UK website, that is the subject of today's big take. Let's get more with Bloomberg's Joe Mays. So Joe, 2+ years on into Boris Johnson's rule in the UK, where are we? How leveled up?
Well, we're actually worse off in many ways than when Boris Johnson first became Prime Minister in 2019. The gap between London and the South East and the rest of the country has widened across multiple metrics that we've tracked in what we're calling the Levelling Up scorecard. So we've looked at measures such as pay, productivity, spending on public services and transport, and across a plurality, a majority, we're seeing that London and the South East has continued to pull ahead of the rest of Britain. So clearly this is very disappointing for Boris Johnson, and he's had distractions. There's been the pandemic, there's been the war in Ukraine, but the picture is pretty grim.
Yeah, I was going to say, I'm sure if we asked the government, they'd make some mention of a global pandemic, Joe. I mean, to what extent does that excuse them? I don't know. Maybe that's for the voters to decide. But how did you decide how to measure this? Which metrics to use? Because this whole concept of levelling up has remained very ill-defined for a very long time.
Yeah, so the government has published a policy paper on levelling up with 12 missions that they're trying to hit by 2030. So we simply took those missions ourselves and built the metrics around them. So we take a pretty holistic picture on levelling up. We look at lots of different metrics, not just economic ones, but broader things like well-being and your life expectancy. And using that holistic picture, we can say, yes, whether your area is narrowing the gap with London and the South East, which is what Boris Johnson wants, or whether it's falling further behind. And as our reporting shows, most cases are falling further behind.
Joe, thanks very much. Bloomberg's Joe Mays, thank you for that. Now, staying with the UK economy unexpectedly shrank in the month of March as the cost of living squeeze forced consumers to cut back on spending. This puts doubt on the Bank of England's ability to keep hiking interest rates. Joining us now is Sandra Horsfield, economist at Investec Bank. Sandra, and you wonder, good morning, you wonder whether the markets are starting to wonder whether the Bank of England will be able to hike as expected. Yes, that was the sort of mean opinion, if you like, of the Bank of England policymakers last week. But there were dissenters on that front, some saying it wasn't the right path of action. And we see interest rate differentials perhaps pricing in that might not happen. We might not see so many interest rate hikes. How much opportunity to hike do you think the Bank of England has?
I think that's really the key question. How do you balance prospects of potentially weaker growth coming as a result of the cost of living crisis, denting real household incomes, against the very high inflation rates that we're seeing at the moment, and those becoming entrenched perhaps in wage expectations, exceeding productivity gains? And if we get that, then further interest rate hikes are necessary to stop those second round effects that policymakers are worried about. In our view, the markets had gotten them ahead of themselves in terms of the amount of tightening that can be expected. And perhaps some of that realization is now starting to be built in.
Matt, jump in.
Sandra, I'm reading that Boris Johnson has seemingly no plan to help Britons with the inflation they're facing, and that his level up promises have not come true. In fact, we're seeing a worsening of the inequalities in the UK. Is there anything the government should be doing to help citizens deal with the inflation that we're seeing? And is it fair now, 2 years on, to expect some kind of progress in leveling up?
It's a very good question. I think right now we're dealing with a situation where we have, against all of that, still the legacy of the pandemic and the very big fiscal help that the government provided at the time to get the economy through this experience. So now the question is, are we able to progress with fiscal consolidation, getting fiscal books back in order, or do we actually have to do more? at the current juncture, with a huge squeeze on real disposable incomes, we suspect the government will have to do more, and perhaps even sooner, but at the latest, at the time of the autumn budget, those hints are starting to come in.
Can I ask you about European growth more broadly then, Sandra? Clearly, there's a lot of focus on energy policy and what energy policy decisions will do to the German economy, to the broader European economy. And I spoke to the Commerzbank CFO earlier on today, who was saying, look, if we stop importing gas from Russia, that will cause a German recession. And there are plenty of economists who have similar views. What's your expectation for Europe?
Clearly, the euro area in particular is most exposed to the situation through energy, as well as through general trade linkages with Ukraine and with Russia, of course. We think, in general, one helpful factor that we're getting is we're actually having some coincidental fiscal support. The next generation EU funds are being dispersed, which so happens to be in this year when we have all these headwinds coming. That's one factor that will help Europe. If you look at company order books in general, they're still very high. But of course, if the gas taps are turned off, there will be a very difficult situation that can't be replaced in the short term.
Right, yeah, I got a similar message from the CEO of Siemens this morning. Thank you very much, Sandra Horsfield, economist at Investec Bank. Thanks to her for joining us. And for more on all things UK growth, where we started that conversation, economics and politics and growth stories across the UK, be sure to check out our flagship news site, bloomberg.com/UK. That is live from today. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Anna Edwards. Now, Volkswagen is reviving the Scout brand here as an electric American truck to help gain market share in pickups. I spoke with the CEO of Volkswagen, Herbert Diess, about that yesterday, along with some of the challenges automakers are facing as a result of inflation.
We think that the United States is really the economy and market where we should invest a lot more. Now we are still very, very small in the United States, and we have now a good track record. We are profitable. We should use this momentum of electrification. And now owning a real American brand and bringing it back to market is a huge chance. And altogether, those efforts should lead to a situation where by 2030, we should be around 10% market share, which is necessary to be sustainable in the American market. So we need the volumes, the economies of scale, and we need to become more American.
Herbert, when you look at pickup truck, I mean, prices here just keep going up. Chevy just put out a new ZR2 of the Silverado that starts at 70 grand. The Ford Raptor, if you option it right, is at least 85 grand. The Ram TRX gets up to 100. What do you think about the incredible price increases that we've seen here? Are you seeing the same thing there?
Yeah, you know, that's what happens around the world currently because of raw material prices are really soaring. I hope that this is a transitional effect. In the battery cars, it's mostly the raw materials for batteries, which are not, those prices don't have a real substance, or because we have a shortage in the market. So they should come down on the midterm and long term to reasonable price levels. And then the EVs, the EV pickup trucks will be also a very economic alternative to the ICE cars. So if we enter, we enter, or when we enter at scale and at the right price point to be attractive to many Americans.
In terms of chips, when do you expect the supply-demand of chips to come back into equilibrium? You know, a lot of people said last year, maybe by 2022, and the beginning of this year, they said maybe in the second half. Now we're hearing 2023 and even 2024.
Yeah, you know, it's a combination. We have very strong demand for cars worldwide, basically. And people want to spend the money on cars, and we have this shortage. We will see a big alleviation through this year, I would say second half, because I know that a lot of wafer production went into automotive in the past months. So I would say by August, September, we should see a much better situation. We will still see shortages in some of the components because building up additional capacity for semiconductors just takes time. It takes years. I think a lot of investment is going in now. We will see continuous improvement. Is it fast enough? Probably not.
That was Herbert Diess, the CEO of Volkswagen. And Anna, for those of you outside of the U.S., the International Scout was an amazing brand. It looked basically like a Bronco or...
so you tell me.
Just a really cool off-road truck, and it'll be cool to see it revived.
Herbert says that he needs to become more American, or they do. I don't know. Can he do it, Matt? You can tell me later. That is it for the early edition. Surveillance is ahead with Tom, John, and Lisa. They'll be hearing from Christian Müller-Gliessman. They'll continue to talk about sell-off in stocks. This is Bloomberg.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
There's certainly a lot of moving pieces in the economic outlook.
We have seen a lot of froth come out of the market.
I think the market is more trying to find a level.
These numbers obviously are too hot.
The Federal Reserve has not been forceful enough in stating not just what their goal is, 2% inflation, but the means to achieve that goal.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This price action is absolutely brutal. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz and Kelly Lyons, I'm Jonathan Farrow. TK taking the day off to watch the North London Derby. We'll talk about that later. Down 0.75% on the S&P, on the Nasdaq down more than 1%. The carnage out there, Lisa, it gets worse.
We've been saying, when do we get capitulation? Are we starting to get a bit of it, given the fact that this is a growth concern more than just a rate concern? And you're seeing this because as you get carnage, a little bit of a haven trade in more of the traditional places, including treasuries, a unique moment after so much rate fear.
Yields down for a fourth straight session. Yeah. I was talking about the carnage in the last 24 hours. Have you seen the performance of some of the biggest names in this equity market? Netflix year to date down 72%, Facebook down 44%, Amazon down 37%, Tesla down 30%, Microsoft down 23%, Google down 21%, call it 22%, Apple down by 18%, and Lisa, in the pre-market for some of those names, it gets worse, not better.
I saw when you put that out on Twitter, I thought it was fascinating because of the size and scope. Most ever, most since 2008. Is this 2008? It really hasn't felt quite like that, but perhaps 2000, 2002, when you get certain names that fall out of bed completely and there's a repricing within specific parts of the market. We have not seen a wholesale financial market collapse as of yet. The question is, are the risks starting to build slowly as you start to get a bit more of a mass exodus?
Kelly, a theme for us to build on through the morning is just the wealth destruction we're seeing through those names, through this equity market, and something you've been covering for the last couple of days through crypto too.
Yeah, through crypto too. I mean, I could go all day on stable coins, but the fact of the matter is a lot of the people invested in cryptocurrencies, John, are mom and pop. They're retail traders, people that have been putting money into this market since the bottom of the pandemic and are now really feeling that pain. Just when you look at the major averages, more than $6 trillion worth of market value has been wiped out just since the end of March. If you bought into the NASDAQ 100 at any point in 2021, you have now lost money. And at some point for the American consumer, that's going to matter.
You put it all together, just the nature of this move in this market cross asset, Lisa, it has all the traits right now of a growth scare. It's changed somewhat from an inflation scare to a rate scare to a growth scare. And I think the bond market's speaking to that through the last week.
And I think that that really is the takeaway. We have reached that pivot point where people have baked in a Fed tightening cycle that will be robust. And then they're getting to the other side of it. And they're saying, what's next? What's going to save this market at a time when the global economy is slowing? And frankly, these price pressures are not going to abate whether it's oil prices, whether it's gas in Europe, or whether it's the China lockdowns.
Thursday morning, good morning. Here is your price action. We are negative 0.75% on the S&P, on the Nasdaq 100, down again by more than 1%, negative 1.1%. In the FX market, the euro breaking down. We'll talk about that one later. That currency pair, negative 0.8%. Euro dollar just about holding on to 104.30 there. And in the bond market, this is it, isn't it, Lisa? Bramo, we're down 10, 11 basis points on a 10-year, 281.55.
You remember we were up at 320 and people were saying we're going to get to 350. Could we get to 4% on a 10-year yield in the near term? Now we've gone way back down. People are saying we saw peak yields. This is very much, as you were saying, as we've been talking about all week, a growth scare coming to the fore and rate scare moving to the back. 8:30 a.m. we get the latest read on U.S. economic data. U.S. April PPI, producer price inflation. How much does that also surprise to the upside after yesterday's CPI? The initial jobless claims we also get at 8:30, and I want to see what the trend is given the fact that we've seen the U.S. unemployment rate fall to near the lowest levels going back into history and certainly pre-pandemic, at a time when people are saying that that unemployment rate has to rise in order to reduce some of the froth in the labor market. Do we see signs of that? Do we see it moving in the other direction? And does that give us some sort of sense that perhaps the Fed is even that much further behind the curve? At 12 noon, we get the USDA agricultural supply and demand report. Normally, we wouldn't be talking about this, but it's actually one of the most important things we're going to be talking about because food price inflation has risen to a record high according to a UN index. And we want to see how much of a shortage there is in corn, in wheat, in soybeans, so that we can figure out how much more this has to go and what potentially could be some of the frictions and fissures that result. And at 1 p.m. we get a Treasury auction, $22 billion of 30-year notes. How much do we see an ongoing flight to safety in debt that had been left for dead over the past few months, given the fact that people are worried about longer-term growth and worried, John, about the consequences of some sort of downturn in the near term and then a reversion to an even lower trend of inflation and growth after that?
Yields down again today. Lisa, thank you for that. Just looking at things, Kaylee, 285, the high on a 2-year last week. We're back to 257. We're down 7 basis points. A 10-year, the high of the week, 320. We're back down to 282. We're down 9 basis points. These moves, Kaylee, are more than notable.
Yeah, they've been remarkable. And what's interesting is really what has driven them as well. We've seen break-evens coming in substantially. So inflation expectations are coming lower, and this really just reinforces this is no longer about the Fed reining in inflation. It is about what happens as a result of that. To get inflation under control, do you ultimately have to cause a U.S. recession? And that is what a flattening yield curve is signaling to some extent, John.
2s, 26 basis points, down about 4 basis points on the day. Mark Howard joins us now, senior multi-asset specialist at BNP Paribas. Mark, a lot of people have lost a lot of money. Confidence is absolutely battered. What do you tell those people today?
Just like you did, Jonathan, I say it's been brutal, and it's likely to remain brutal for a while when you look at the cross-market activity of late and the migration of these worries from, the rate market, the currency market, into the equity market, back to the rate market, and now it's creeping into credit. And as Lisa knows all so well, when you start to see a give up in the credit market, that's when you worry about the real economy. And then add to that what we got yesterday, which was a broadening of the inflation concern out of the producer sector into the service sector. It means that the consumer is going to feel this longer as the year plays out. And the important narrative there is that if the Fed's not going to come and save the day, the consumer has to. And it looks like the consumer's not going to be as robust as many had hoped for.
Mark,
I tell people you gotta steel up for some rough months ahead.
Mark, this market is moving incredibly quickly, and a lot of people said that speed matters. At what point does the pace of this market start to scare you, start to worry people about some sort of financial market breakdown?
Well, it worries us when you start to see financial intermediaries have measurable problems. We haven't seen that as yet. But like Kaylee was just saying, we're watching the crypto space really closely because, we don't think this crypto winter is like the last couple of crypto winters. There are more players in the market, more sophisticated players in the market. And while, sure, many of the people who've been hurt have been, smaller mom and pops, there are also a lot more sophisticated players in there today than there were 2 or 4 years ago. And they can move markets aggressively, and not just in crypto, but in their hedges against crypto. And I think that's some of the price action we've seen recently, both in equities and in rates. Don't just look at the currency markets when you think about what people are doing in crypto. You got to look at the rates market, and I think some of the safe haven trade you've seen may also be some offset hedging from crypto.
So crypto stories usually are somewhat out of the mainstream of the financial markets. They're their own asset class. At this moment, we are seeing more than $200 billion wiped off of the cryptocurrency market in a day, according to some estimates. But Aaron Brown, a Bloomberg Opinion columnist, raised another question, saying that this is actually a bigger concern for the broader financial markets because this raises an issue of what fissures happen when you have money market funds trying to sell treasuries as liquidity that have lost so much value and then fail to come up with the same amount that they have promised their investors. Are you starting to see concerns on that level, on some sort of systemic level?
We have not, but I think Aaron is right to flag that as something to monitor. We have not seen that specifically in our flows or in some of the things that we look at in the internals. But yes, there are concerns about market structure within treasuries, for example. That's been flagged by regulators and others. But there's a lot of focus on that. I think I worry a little bit slightly differently, which is the seepage of the worries in the broader blockchain architecture and the repricing of those platforms flows into the whole venture capital ecosystem in a way that we haven't seen before, because there wasn't nearly as much invested in DeFi a year, 2 years, 3 years ago. So there's a lot more exposure. That's where the SoftBank news today is particularly noteworthy, because they're one of the biggest investors in this rapid growth space. Bitcoin is a corner of that, but there's other sectors, the broader blockchain ecosystem, and even biotech, which have taken a terrible pounding. And so this broader growth sector, which has been hiring a lot of people, not just the Pelotons of the world, but a whole host of them, those employers are going to start to reverse. We're already seeing it, right? And that's going to affect the real economy in ways later this year.
Yeah, that record loss for the SoftBank Vision Fund, certainly remarkable, Mark. As we talk about the pain across asset classes, what would you be looking for as a signal of a meaningful bottom, potentially an entry point?
Well, how about 3 more rate hikes from the Fed at 50 basis points? I think, how about just starting QT, one of Jonathan's favorite narratives going back a couple months ago? We haven't really kicked in on that. So we want to see more of the removal of accommodation. There's going to be a lot of price. There are going to be some dead cat bounces. There are going to be some relief rallies, but that's not going to give me any solace. We need to see the Fed get serious about withdrawing accommodation. And then we need to see further repricing in the credit market. As Lisa said a couple days ago, we've seen triple C's start to gap up, what we call decompression within the credit space. And we need to see more of that, not just in high yield, but also in the investment grade market. That to me is going to be a sign that you've gotten closer to a turn, but we haven't really gone very far there yet.
Hey, Mark, it's starting though. It's starting. Mark Howard there of BNP Paribas. Mark, great to catch up, buddy. Consensus now, 50 at the next meeting, 50 after that. Wells Fargo just published, Lisa. In order to tamp down inflation, we now believe the Fed will raise the effective federal funds rate at a slightly more aggressive pace this year. Look for 50 in June, 50 in July, and 50 again in September.
Honestly, yesterday's CPI print gave nothing for anyone to feel comfortable about, because we did not see the degree of deceleration that many people had hoped for.
Things have been extremely uncomfortable for a lot of people. Futures down 0.6% on the S&P. With Lisa Abramowitz, I'm Jonathan Ferro. Happy to stay in the seat. Katie Lines, TK back with us tomorrow. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. Cryptocurrencies resumed their declines today. The collapse of the Terra USD stablecoin triggered a flight from many popular digital tokens. Bitcoin fell below $26,000 before rebounding. Backers of Terra USD are trying to raise $1.5 billion to shore up the token. The British economy unexpectedly contracted in March. Gross domestic product fell 0.1% from February as the cost of living squeeze forced consumers to cut back their spending. That's throwing doubt on the Bank of England's ability to keep raising interest rates, and it's putting pressure on Prime Minister Boris Johnson's government to respond. Policymakers at the Federal Reserve face pressure for more aggressive action after a hotter than expected inflation report. So far, though, officials are sticking with their strategy to raise interest rates by 0.5 percentage point at each of their next 2 meetings. St. Louis Fed President James Bullard told Yahoo Finance that the half-point moves are a good benchmark for now. Senate Democrats were blocked in an attempt to enshrine abortion rights in federal law. All Republicans and one Democrat, Joe Manchin of West Virginia, voted to keep a bill ensuring nationwide access to abortions from reaching the Senate floor. Senate Majority Leader Chuck Schumer said he wanted to put Republicans on record just as the Supreme Court is poised to overturn the landmark Roe v. Wade decision. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells. No one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Earnings season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable. We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan's spot on.
Delta flying.
Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Right now, America's fighting on two fronts. At home, it's inflation and rising prices. Abroad, it's helping Ukrainians defend their democracy and feeding those who are left hungry around the world because Russian atrocities exist. Putin's war has cut off critical sources of food.
The President of the United States speaking a few times this week already on inflation. From New York City this morning, good morning. Futures negative once again on the S&P, on the NASDAQ too. We're down 0.75% on the S&P 500. On the NASDAQ, we're down by more than 1%. Yields are lower by 9 basis points, call it 10, 282.45. Some of this reflecting a growth scare that's gripping this market with commodities lower. Copper, sub 9K. Crude, 104, just about 103.99 with negative 1.62%. The president, Lisa, yesterday, in a statement following that inflation print, mentioned the Fed. These were the words. They'd always acknowledge the independence of the Federal Reserve, and then it's an and but. Yeah. And here it is. I believe we've built a strong economy and a strong labor market, and I agree with Chairman Powell with what he said last week, that the number one threat to that strength is inflation. I'm confident the Fed will do its job with that in mind. What do you make of that?
Basically, he's giving the go-ahead for them to raise rates and to tighten as much as possible, but he's also shifting the blame. This is a complete punt to basically say it's their job to rein in inflation. They're going to have basically the spotlight on them and look to them for a reason why it's not going down if it doesn't.
Did this feel like the blame tour for you over the last couple of days?
Honestly, blame Putin, blame the Fed, blame geopolitical issues, blame the lockdowns in China, blame whoever, but it's not necessarily going to be an introspective look at how we got here in terms of some of the policies. There's a big debate around how much the stimulus checks really added to this. That will continue to be a debate. It's strange to me that they're not trying to get ahead of it and frankly addressing it head on and doing even studies on it.
Let's have that conversation right now with Bloomberg's Maria Tadeo in Weissenhaus, Germany, and Jack Fitzpatrick down in DC. Jack, first to you, sir. What's the plan? He's talked a lot about it over the last couple of days. Lay it out for us.
On inflation, you guys are right to note that the president is looking to the Fed a lot. That serves as a sort of it's somebody else's job line. It's a scattershot plan aside from that. They'll talk about a bill that would increase taxes in the way the Democrats have talked about. That would be a much longer term issue, obviously, as it relates to inflation. They'll talk about meat processing companies and gas prices and other things that they can do here or there. But the legislative outlook is very limited on what the president can do. And so you're going to continue to hear him talk about a scattershot approach on his own end, but very frequently looking to the Fed to really hit at the crux of the inflation issue.
Jack, we talk about President Biden, his view on inflation, how he's coming out and portraying this. Is this really just him? How much dissent is there within his administration about how the president should be approaching this, both in rhetoric as well as in action?
In actions, there's not enough dissent. There's not that much dissent because their options are very limited. There is a push now and then from Democratic lawmakers who want a gas rebate. There was the discussion about a gas tax holiday. Again, they're very limited there because they can't just snap their fingers and do something without Republican support. In terms of rhetoric, the president has talked about trying to get out on the campaign trail more. Naturally, he will do that as we get closer to the midterms. But there's a bit of a sense among Democrats broadly that their hands are tied to a very significant extent because they're waiting to see exactly what happens in Ukraine. They're hoping that we can have more of a global economic reopening and move past the pandemic. But there is an understanding that a significant amount of this is out of the president's hands in the short term.
Well, on that subject of the war in Ukraine and the resulting embargo on Russian fossil fuels, that the U.S. has put into place. Maria, the headline out of the IEA today, Russian oil revenues are up 50% even despite that, because, of course, there's still buyers out there, and Europe hasn't put an embargo in place yet. How much is the focus on energy at the G7 meeting where you are in Germany today?
Yeah, this G7 meeting that is going to start here in Weissenhaus in about 2 hours' time. Of course, the energy conversation is always present in Europe. When you look at gas, I mean, forget about it. This is not even going to feature majorly in this discussion. When you look at the oil embargo, well, at this point, it's almost an embarrassment for the European Union. There was a G7 communique that came out days ago on Sunday, and the Europeans are still working on their plan that they announced a week ago, and we still don't have a deal on it. Now, the other big focus, of course, will be that relationship with Ukraine. And I should note, Kaylee, that Dmytro Kuleba, who is the Ukrainian foreign minister, will be here today participating in this G7 meeting. The Moldovan, also foreign minister, will be attending the meeting. And a lot of this will focus on the financial needs for Ukraine. Remember, the country says they need on a monthly basis now, and this is hard cash, $5 to $7 billion. That's to pay basic expenses. The other big conversation will be about NATO and the EU. The Ukrainians have had a major reality check. NATO's not going to happen for them, but how about the European Union?
If you're ever going to be a broadcast correspondent in life, be the European correspondent. The European tour, Bramo, continues for Maria.
It's basically the European tour of vacation spots, Maria. Are you enjoying your time on the beach there?
Well, I would say yeah, but the fact that the weather here changes by the hour, the food in Germany is a little bit...
There we go.
Overall,
There we go. There we go.
With a nice
feel
team.
for you.
They're
Lives
all
in
German,
Brussels,
so they
but
hate
she's
me
still
right now. They're
Spanish.
all Germans. They hate me right now.
Maria, it's great to catch
Hans,
up.
my cameraman, he's not happy about this at all.
Maria Tadeo, awesome as always. Jack Fitzpatrick there down in DC. Isn't that true? You can take her out of Spain, but you can't take the Spain out of her. That's the story.
Bad.
I mean, the food is... Anyway. Javier Blas, he wrote to me this morning and he talked about the refining issues. This is really, really important stuff now. So a lot of people waking up, seeing the price of gas, the price of diesel, looking at the SPR release from this administration, trying to boost output. As Javier's pointed out repeatedly, Lisa, you have to convert the crude into something. And to do that, it's all about the refiners. And he's really concerned about refining capacity and really concerned about prices and availability.
He was talking about the IEA monthly market report, and he said he has never heard language like what they were using in terms of the shortage of refined goods. And we are seeing that in the prices of some of those refined goods and how much they're divorcing themselves from the underlying price of oil. How much is that going to really be the driver, particularly because that's what consumers feel, right? I mean, we don't feel the spot market.
In a massive way, Lisa nailed it. Down 0.75% on the S&P and the Nasdaq 100, down by 1.1. Yields lower by 9 basis points on a 10-year, 282.99. The volatility, I think is fair to say, continues. Heard on radio, seen on TV. This is Bloomberg Surveillance.
companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City this morning. Good morning on TV and radio. We pull back once again on the S&P down about 0.5%, on the Nasdaq down 0.8%. Year to date, the S&P down 17 percentage points, the Nasdaq 100 down 27. It has been that bad. Beneath the surface, there are some even bigger losers, which used to have a monster market cap, and now, let's just say it, less so. In the bond market, things are changing up. We need to talk about it. This is looking more and more like a growth scare. 4 straight days yields lower, down another 9 basis points on a 10-year, 282.99. The high this week, 320. We breached that level intraday. We came all the way back. On a 2-year, the high last week, 285. We got to that level. We come all the way back, down another 5 basis points to 258.39. Are we questioning how far the Fed can take this? Let's take a look at foreign exchange. The story used to be in FX, an aggressive Federal Reserve, a BOJ that would do nothing, dollar yen to the move. Dollar yen's coming back now. It's different. 128.75. We're down 0.9% on that currency pair. And I would say, Lisa, this is more representative of that classic risk aversion move. Yen strength, yields lower. It's all starting to build in a different way compared to where we were maybe a number of months ago.
We're getting more of a traditional growth scare. How this actually shakes out remains to be seen. But you are seeing that in some of the more traditional currencies. However, how long can this last? I really do wonder if this is just a breather or if this is something more substantial, because what you are seeing right now is treasury yields going in. Are we seeing buyers start to come in from Japan, or is this just basically a fluke, people pushing out their shorts to get ahead of whatever comes next?
The dollar index right now, the strongest since 2002. The euro just seems to be in a lose-lose position at the moment. Everything going the wrong way for it. Euro dollar 104.33. We're negative 0.75%. There's a meeting for the ECB in just a couple of weeks' time, Lisa. I think it's June 9th. That is a tough spot for this ECB to be in. They hike, people talk about a recession. They don't hike, they talk about inflation getting out of control and the euro heading even further south. It seems to me that if they don't hike, it's euro negative. If they hike, it's euro negative. And that seems to be the consensus position on the street right now, which, Lisa, is why a lot of people don't want to buy it.
I was just going to say exactly that. There was a story yesterday out in Bloomberg talking about how the consensus right now is to get to zero and beyond, to get to positive base rates in Europe by the end of the year. That should be a euro positive if you believe in the transmission mechanism of strengthening the currency, but that really leads to a weaker economy.
Right now, that's not the feeling. Euro dollar, Lisa, 104.31.
All of this, are we there yet? I think that that's basically the sentiment right now. Are we at the end of capitulation, or the beginning of capitulation that will lead to a buying opportunity, or at least some washout that can give some stability? Joanne Feeney has been tracking this. She's portfolio manager and partner in Advisors Capital Management, longtime advisor to the likes of the Federal Reserve, the IMF, the World Bank. Joanne, you are looking at this scenario. Are we there yet in terms of capitulation?
Well, great question, and good morning, Lisa, John.
Clearly the market is on edge. There are a lot of real risks out there that have people very cautious. It started out with rising interest rates way back in November, that concern. But now it's really shifted to more concern about real economic activity risk. And obviously the data out of the United Kingdom this morning with their decline in GDP has people more concerned that we could see a broader global economic slowdown. So I think valuations have come in quite a lot. And that, I think, will help people start to look for opportunities where they can be repositioned for a longer-term appreciation. It may still be rocky for a while, but boy, some of those valuations have gotten very attractive.
Joanne Finney there of Advisors Capital Management. Here's the good news. I'm told that you could hear that. Here's the bad news. I couldn't. So it's hard to respond to an interview when I can't hear Joanne and what she's got to say. Joanne, we're going to try and re-establish that, and we'll come back to you. But I'm pleased to say at least that our audience heard the answer to Lisa's question. So I'm told.
Well, yeah, you can write in and tell us what the most important points are, and we can follow up the conversation.
I'm going to trust the control room right now on that. They're going to tell me once that's re-established. Lisa, as we reset, we did this about 30 minutes ago. We're talking about real wealth destruction now. Now, it depends on your time horizon. If you go back over the last couple of years, there's a lot of people still in the green and the money, but this is feeling really, really bad right now. You're going to look at your statements, you're going to see the losses in the equity market, the losses in crypto, you're going to look at your bills, utilities, just to go through the numbers in CPI yesterday, utilities were up 13.7% from a year ago. That's the most since 2008. Shelter costs, month on month, for a third straight month, up 0.5%. The most since 2005. Lisa, these are real issues. And when people start talking about a cost of living crisis, I don't think that's a stretch. That's not being too dramatic. That's what it feels like right now for a lot of people.
Right, and you're seeing that also borne out in equity markets in specific pockets. You talk about the re-rating of risk within the equity markets. Jonathan Gollop of Credit Suisse put out a really interesting report talking about how much valuations and what's expensive and what's cheap ends up coming out. And basically, what's been expensive is still somewhat expensive in terms of big stocks, but you are seeing within the tech space some carnage. It's just shocking to me that people are not swooping in and buying the behemoths that were thought of as the safe trade just a month ago. At what point do they become safe again?
The problem for the politicians as well, the ones in control, real wages down for a 13th straight month in April. That is a problem for this White House. Joanne Feeney of Advisors Capital Management. Joanne, I'm told that you can hear us, and I'm told that I might be able to hear you. So let's take a shot at this. Joanne, the wealth destruction, the tightening of financial conditions, the markets are always trying to anticipate things. Sometimes they're wrong, sometimes they're right. When do you expect to see the damage done in this market start to translate into damage into the economic data?
You know, John, it's almost like all data is bad data these days, whether it's a good sign like inflation slowing down, whether it's a good sign like imports being very high, which is a strong signal of consumer demand. But the market is simply on edge, and they are clearly running to safety, as we're seeing in some of those stock moves that you guys described. But investors, I'm finding, are taking a different view depending on how they're positioned. You know, we're hosting our annual meeting this week down in Hoboken, and we have, over 100 of our advisor partners here. Talking to them last night at the reception, now maybe alcohol helped, but they weren't as worried as I really was expecting them to be. And maybe it's because that some of our leading strategies for them are income-oriented, high dividends, bigger, stable companies with really strong balance sheets, and it makes them comfortable and able to ride out this volatility in the market. And that's not going to be true for all investors. Growth investors clearly are suffering. They're going to have to wait longer, I think.
Well, talking about some of those specific companies, Joanne, I noticed Amazon is on your list here that you sent in. That is a stock down 37% year to date. It is trading at levels we last saw, and I believe April 2020, almost like the pandemic didn't even happen. What do you make of that price action, and are investors getting something wrong?
Yeah, I do think that one's overdone, and I think several of them are overdone. People really responded badly to the retail slowdown that Amazon was seeing, and clearly that was going to be the case after the pandemic. You know, really pretty much a lot of it's behind us in terms of spending patterns. But what people are overlooking with Amazon is their cloud business. Amazon Web Services is, the biggest and going to be the biggest profit generator for many years to come, with, over 35% growth for many years to come. So I think, that's one where we didn't buy it until quite recently because it, valuation was too high. And we think that's going to be a place that investors will increasingly turn to ride out, perhaps if we get a stronger slowdown in growth, perhaps if we get a recession, the companies exposed to cloud are going to see their demand continue to grow over multiple years. Investors are going to want to be there to build in some recovery, particularly over the long term in their portfolios.
In what other areas have valuations come in enough that it's safe to buy at this point?
Well, Amazon, is sort of like a tech consumer discretionary company. But if you look in infotech, for example, companies like Broadcom, stalwarts in cloud computing and software as well. Companies like Qualcomm have come down a lot. They not only provide chips for smartphones, but they also are increasingly providing chips to automobiles, to industrials. Connectivity is spreading. That's another long-term trend that's only going to grow over time. And they're a company that sells not just the chips, but also the intellectual property on which they make, obviously, very, very high margins. So that's a couple of other companies that we think have really traded off far too much. Good place to go if we do end up in a cyclical recession. You want to own companies that have secular growth drivers over the long term.
Joanne, awesome to catch up. And my apologies about the technical issue. The good news is that everyone else could hear you. Joanne Feeney there of Advisors Capital Management. Mohammed Al-Arian out on Twitter just moments ago. We'll catch up with him tomorrow on Bloomberg TV. This is what he had to say, Lisa. Growth concerns are compounding the unsettling effects of inflation and liquidity worries. The continued large wealth destruction is starting to trigger spreading market functioning worries as those keep an eye on the volatile and gapping U.S. government bond market. That's kind of been the story, hasn't it, over the last few months?
So now we flip to where is the Fed put? And I ask this because Jim Bullard even raised this issue yesterday of the St. Louis Fed, where he basically said he is concerned about financial stability and financial market conditions, and he's watching that as they all are. At what point do they care enough to actually back away from some of their rate hiking plans before it even starts? I mean, if we price in the ramifications, do they come in and actually make good on them, or do they back away?
So, Katie, the Fed put is not dead. It's firmly in retirement. What brings it back out of retirement?
I think it's a really good question, considering what happens if you see further deterioration, further wealth destruction at the same time that inflation is not coming down, potentially at a quick enough pace. Because yes, maybe the peak already is in. Now it's about that downward slope and the eventual plateau and how long it takes to get there. If inflation is still at a 5 handle at the end of this year, is the Fed going to be comfortable tapping the brake pedal once again, or is it still going to feel like it needs to accelerate the tightening of policy? How do they balance those two things if they're happening simultaneously?
The unknowns, one of them, and you touch on it, Kaylee, how much inflation will they tolerate at year end if growth is decelerating in the way that some people in this market anticipate? Lisa, the other issue as well, and Priya Misra has made this point several times over at TD, is that we're already going to see some damage, not based on what they've done, because the Fed hasn't done much. QT hasn't started. We've seen 75 basis points of hikes. It's about what the markets anticipate. Financial conditions have already tightened. You've got mortgage rates through 5%. And as Priya said, no one's borrowing at Fed funds rate. The long bond has already sold off. You're out to 3. Mortgage prices, you've seen the cost of mortgages now, Lisa. And Priya's point really is that A, she doesn't think the economy is as resilient as, say, Chairman Powell believes and others think. And B, that we're already seeing the tightening.
But we're not seeing it translate into the economy just yet. And we saw that with the inflation print yesterday, which raises a conundrum. If the transmission mechanism is markets and the tightening has not been enough, do they need to go harder?
We'll continue to explore that conundrum in just a moment. Equity futures down 0.7% on the S&P from New York City this morning. Good morning to you all. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the First Word News, I'm Laura Wright. In North Korea, Kim Jong-un has ordered all cities to be put under lockdown after the country reported its first COVID case. In the past, North Korea has always denied it had any cases, a claim that's been doubted by outside experts. The country also has refused vaccines from the outside world. Russia's oil revenues are up 50% this year, despite trade restrictions following the invasion of Ukraine. According to the International Energy Agency, Russia earned roughly $20 billion each month this year from combined sales of crude and products. Still, the IEA says that new sanctions could change that. The Pentagon is negotiating to buy a tank-busting drone that would be sent to Ukraine. Californian-based AeroVironment makes the Switchblade 600, which can fly more than 24 miles and linger over a target for more than 40 minutes. The Pentagon has already committed to send at least 700 smaller, shorter-range Switchblades to Ukraine.
The Senate has added a third nominee of President Biden to the Federal Reserve Board. Lawmakers confirmed economist Philip Jefferson as a Fed governor. The vote was 91-7. Today, Senate Democrats say they expect to vote confirming Jerome Powell for a second term as Fed chair. Bloomberg has learned that HSBC has begun an internal analysis to help rebuff a proposal to split off its Asian operations. That proposal comes from the bank's largest shareholder, Ping An Insurance, which wants to improve returns. About 65% of HSBC's pre-tax profits last year came from Asia. The bank argues that much of that is actually business with Western clients. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
People still are confident the Federal Reserve is going to do its job.
But if you keep under promising, what you're going to, what's required, then I think there is a risk to the Fed's credibility down the road.
Dudley, Bill Dudley there, the Bloomberg opinion columnist and senior advisor to Bloomberg Economics. Equity futures right now down 0.7% on the S&P. On the Nasdaq 100 down a little more than 1 full percentage point. Yields in, let's call it 9 basis points, Lisa, 283.35. But that's the trend, Lisa, over the last 4 days.
Growth scare. Where do you find the havens? And the dollar, I think, also, in addition to yields going lower, the dollar continuing to strengthen, which is all tightening for the Fed in ways that is problematic for the global economy, perhaps a bit more than the U.S. economy.
The cost of living crisis as well. Kaylee, the cost of renting at the moment. I don't want to make it too New York-centric. I just saw the data on Manhattan this morning. It gets worse. It does not get better.
It's gotten worse for 3 months. 3 months of record rent prices in Manhattan. I myself am officially priced out. I am moving to Brooklyn next month because I basically had no other choice. But it really speaks to a shelter inflation problem in the U.S. And when you have rents going up and mortgage rates going up as well, which in theory is a problem for people who want to buy, what do you do?
Bramo, these numbers up 6.2% from the previous record set in March, up 39% from April 2021.
This isn't a supply chain issue. I just want to point that out. And this is important because it was a big component of the CPI print yesterday. It was the biggest increase in rent inflation going back to 2006, the biggest increase in airline prices ever. It was up some 18% month over month for airplane tickets. How much is that going to be what concerns the Fed? Because this is going to have a stickier feel to it, John.
And that's the problem for this Fed as we go through this year. Greg Decker joins us now, chief economist at EY Parthian. Let's start here, Greg. Where you see inflation year-end, the Fed sees it something close to 4. Where do you see it at?
I expect inflation to be in the 4% when you're looking at the PCE gauge, but I think on a CPI basis, we're likely to still have a 5% handle on CPI and core CPI. Both are going to be sticky in the current environment. As you highlighted, we have some categories of spending that are going up in prices. Housing is a key component where we're seeing home price inflation feeding through to the CPI index. It's both rent and the cost of owning a home that are going up, probably going to move past 5% on a year-over-year basis. You have healthcare costs rising. You have the likes of food still being quite strong. And you have leisure and hospitality prices also rising as there is still robust demand. And that's likely to last through the summer. So still some upward pressures there in terms of inflation, even though we may be past that significant peak in inflation.
Is the Fed having any effect on that inflationary pressure based on how it's jawboned markets into a tighter financial condition?
Lisa, I think there are really 3 factors that are going to drive inflation lower. I mean, first is that there's going to be cooler demand growth as we move towards the latter part of this year, especially against a global backdrop that's quite weak. That's going to help ease some of the supply pressures. You're also going to see some easing of supply itself. And then you have the Fed pressing very hard on the policy brakes with strong forward guidance that is going to tighten monetary policy and continue to do so, even if there is a slowdown in economic activity. You have rate hikes and you have QT. All 3 factors will weigh on economic activity, will weigh on credit, and importantly, as we've seen, will weigh on financial conditions, which will have an effect on economic activity. So I do think that interest rate sensitive sectors will feel the hit from tighter financial conditions and from higher cost of credit, but that won't happen overnight. That will take some time to see the actual cooling in spending and then the implied effect on inflation.
Given that, and given the fact that what we're seeing in markets right now is people pricing in a growth scare, not just the Fed raising rates more than they had previously expected, do you think that's premature, that we're not going to see the growth scare for longer than people are pricing in?
Yeah, I think we have to be quite clear in terms of the global picture. We have a fragile global recovery. We have the likes of China suffering from a property slump, as well as the zero COVID policy. We have Europe, which is facing a double hit from the war in Ukraine and the higher energy prices, likely susceptible to a recession. I think the U.S. is actually leading the pack still here with a fairly robust economy today. Fundamentals remain quite strong. We're still seeing people spending. We're going to see a hot summer in terms of travel. We're already seeing it in airports. But there is going to be a cooling of economic activity as we move towards 2023. So I think the talk of a recession or a slowdown is not something for today. It's probably something that's likely to become more of a risk as we move closer to 2023, and the economy will be at stall speed, therefore more susceptible to external shocks.
Well, and of course, in theory, that's a problem for airlines who have been raising the price of tickets for the likes of Disney, which, yeah, did really well on parks in the quarter they just reported because people are still going on vacation. But at what point does that exercise of discretionary spending stop being the case? You mentioned China there, though, Greg, and of course, there are some growth concerns that feed into that, but also inflationary ones and supply chain issues. How much is that going to show up in the PPI data, not just today, but as we move forward, so long as that remains the case?
Well, I certainly think that what's happening around the world is affecting domestic inflationary conditions. There's the upside effect from the fact that we have these supply disruptions around the world. The zero COVID policy in China is leading to renewed disruptions in terms of production, in terms of manufacturing and assembly activity, which is affecting, of course, the domestic economy in China, but also affecting the rest of Asia and the rest of the world via these disruptions in supply chains. But in the end, what really matters is how strong demand is in the U.S. for U.S. Inflation dynamics. We still have an inflation backdrop that is pro-cyclical. So whenever we see a cutback in spending, we're seeing lower inflation. We've seen it in used car prices as a good example. That should be the key driver of inflation going forward. Certainly an easing of supply chain conditions would help ease some of the inflationary pressures, but that's not likely to happen overnight again. That's likely to be a process that will take multiple months, multiple quarters before we start to see some easing pressures on that front.
Greg, thank you, buddy. As always, Greg Decker there of EY Parthenon. Can we spend a little bit of time talking about the airlines? I'm so pleased you brought that up. Airfares, Lisa, up 18.6% on a monthly basis, not on a year-over-year basis, on a monthly basis.
I think that covers the gas prices for them, the diesel prices that they're covering. I think that will just about cover it, and then some. We talk about not only the airline tickets going up, but how about planes getting canceled, right? I mean, just the idea that if they don't have a completely full flight, then they will cancel a flight and basically push people to another one. I mean, that's happening. You're getting the idea of shortages of staff. But yes, airline tickets seem to have no ceiling for how quickly they can raise them, and capacity still is pretty much at maximum based on what they're offering in terms of flights.
Not building it out. They're not building out capacity. Can you think of another industry out there right now, Kaylee, where prices are up this much and customer service is down just as much? Can you think of another industry?
No.
I can't.
I don't think I can, John, and it really speaks to pandemic-related dynamics in that you do have so much pent-up demand for travel that people are willing to shell out. But at the same time, because of the pandemic, you also have a serious labor supply problem. And I don't think those two forces coming together simultaneously are as evident anywhere as they are in the airline space.
I spoke to the CEO of an airline recently about this, Lisa, and he turned around to me and he said, "But you haven't been flying with us, and that's why." And I didn't want to embarrass him because I have.
So now you are.
They're part of the problem too. I just haven't named them. But if you remember the conversation, it happened on air, and you can work it out. Futures down 0.5% on the S&P, on the NASDAQ. We're down 0.9%. From New York, this is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
There's certainly a lot of moving pieces in the economic outlook.
We have seen a lot of froth come out of the market.
I think the market is more trying to find a level.
These numbers obviously are too hot.
The Federal Reserve has not been forceful enough in stating not just what their goal is, 2% inflation, but the means to achieve that goal.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is not getting better. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz and Katie Lyons, I'm Jonathan Farrow. Futures down 0.4% on the S&P. Bramo on the NASDAQ, we're down 0.75%.
So why is nobody buying this dip? Because we heard that people earlier in the year were looking for a better price point to come in. Is this a viable dip? No. It seems like people are waiting for another shoe to drop. What is that? What are they going to get that's going to give them conviction one way or another?
The psychology has shifted in a massive way. The buy the dip mentality has been retired alongside the Fed put. I had a message from Steve Chevron of Federated yesterday. Equities were up off the back of the inflation report. Do you remember that? It lasted about 5 minutes. He just said, I do not have confidence in this. I do not trust this. I think that's representative of so many people who are looking at the moves. You see the NASDAQ down 27%. We've gone through the single names, these big tech stocks down by monster amounts, and they're still nervous. That's when the psychology starts to shift the other way, and you're really gripped by what we're looking at now in the bond market, a growth scare.
John, you've been saying this. We have seen a bubble burst, and that's your words, basically talking about some of the tech names, some of the high flyers that have gotten absolutely eviscerated, down 70, 80, 90%. If you look at some of the pandemic darlings, we're not seeing a blowout when it comes to financial conditions melting down. How much are people waiting for something to break? And I keep going back to that because when you get the likes of the dollar strengthening this much, and you get bonds and stocks selling off in tandem, things happen. When things move this quickly, things happen, John.
Things break sometimes. Are you worried about financial stability, Bramo? What is it?
I am, to be completely honest, and the crypto sphere is a bit of a taste of that. What happens when money market funds go to sell their assets of treasuries and find that they're worth a lot less and they have to redeem some of their cash positions? What happens when some of these people look at their positions and start to sell? I mean, we hadn't seen mass selling. Are we starting to see it now?
This is wealth destruction, Kaylee. On the way in through Manhattan today, speaking to my Uber driver who was talking about how down he was about what was happening with crypto, how much money he'd lost in the equity market, in crypto, how much more expensive it was to drive the car. A lot of people are going through those issues in real time.
Yeah, and these are people who had money to spend during the pandemic. They had stimulus checks in their pocket. They were putting them to work in the financial markets. And now a lot of people who have gotten into the market over the last, say, 14 months have now seen all of that gain just absolutely eviscerated at the same time that that fiscal impulse is waning. So what is the American consumer to do when you see that kind of wealth destruction? You are faced with higher prices on rent at the gas pump. That's when you start to have a real conversation about demand destruction in this U.S. economy.
We've spent, and we're spending a lot of time talking about the landing strip for a soft landing. Lisa, we had the conversation repeatedly yesterday. How much narrower has that landing strip just got after the data of the last few weeks?
A lot of people say it's incredibly narrow to the likes of almost impossible because the Fed has to act, and they are acting in the face of what a lot of people see as slowing growth. And we're already seeing some of the demand destruction around the edges and retail sales that came in negative on a real basis. At what point does the Fed rethink they can't? Because this is not stagflation, but slowflation. This is something else that's really difficult for them.
The Fed's got a problem. I think that's stating the obvious. Let's whip through the price action right now. Your equity market's shaping up as follows on the S&P. We're down 18, we're off 0.5%. The Nasdaq down 0.9% is nothing compared to what we've seen, but if you're hoping for a bounce, you don't get one this morning. The Nasdaq 100 down by 8 or 9%. Yields come in by 8 basis points. Lisa, I find this absolutely fascinating. From 320 down to 283.71 this week alone, and down another 8 basis points on the day. This bond market has changed.
We are talking about a growth scare now, and not just the Federal Reserve hiking rates more than people think that the market and the economy can handle. And the growth scare perhaps not translating yet into the forecasts for inflation, which still are rising in terms of where we're going to end the year. Why are people not having the conviction to buy at a time when you are seeing fundamentals continue to be strong in a lot of the companies that are the stalwarts? And Gabriela Santos, global market strategist at JP Morgan Asset Management, is joining us now. Gabriela, what will give you the conviction to go in there and say, this is it, this is the washout, we can start to buy?
Lisa, I think the issue is we have 3 things happening at the same time. There's this growth conundrum with investors trying to figure out which is the most likely path from here. Is it a soft landing? Is it a recession? Is it stagflation? But you add on to that a correction of the excesses that we've built up over the last 4 years, and amplified by a third factor, which is very low liquidity in both equities and fixed income markets. So I think at the moment we've seen a big correction in valuations. We've seen nearly a 20% contraction in the multiple, with the S&P 500 now trading at average valuations. But you still have very low conviction from investors to really truly believe this is the end, because you still have all of these uncertainties. So what do we need to see? I think you especially need a bigger conviction on that growth scenario front. So you do need to see peak in housing costs. You need to see peak sanctions towards Russia to feel more comfortable about commodity prices. And you need to see peak lockdowns in China to feel more comfortable about the growth outlook there.
Gabriela, you talked about liquidity concerns, the fact that there is such little liquidity. You talked about the froth in markets that's gotten beaten out by the readjustment in valuations. Are you starting to worry about financial market conditions, about the functioning of the basic nuts and bolts of how things trade and sell?
So in terms of financial conditions, we have definitely seen a tightening in those ultra loose conditions that we had at the beginning of the year. You now have the tightest financial conditions that we had since 2018, but still pretty loose and just approaching neutral levels. So we're not quite concerned about tight financial conditions quite yet. In terms of the actual functioning of the markets, I think at the moment that is not a reason for concern or a need for the Federal Reserve or other regulators to step in. It's just something that amplifies any of the moves that we see driven by the macro stories, and something that causes more risk aversion and a hesitancy to step in from investors.
Well, and your base case is still the Fed being able to execute that soft landing on that very, very narrow landing strip that John and Lisa were just talking about. With each day that passes, how much risk grows around that idea?
So I think you invest based on your base case, which for us is a soft landing, but you diversify the other routes just in case, the recession and stagflation scenarios. So in terms of the investing based on the soft landing, we would still advocate for having a small overweight to stocks, a small underweight to duration, a balance between growth and value. but you want to still be diversifying the other scenarios. So to diversify the recession scenario, it's a small underweight to duration versus a big one at the beginning of the year. It's overlaying a quality factor on top of any of the stocks that we're thinking about investing. And in terms of diversifying the stagflation scenario, it means bringing the prime candidate for stagflation, Europe, down more to a neutral. It's focusing on commodity exporting regions like Canada, and it's focusing on diversifiers like real assets that do well when inflation is the concern.
Well, while we're talking about regional diversification, you mentioned Europe and Canada there. Let's talk about China, which you mentioned at the beginning. Investors kind of need to see something changed with COVID zero policy, but it's not just that. You also have a serious crisis in the property sector. Sunak defaulted today because it didn't make its payment on a dollar bond coupon after that grace period expired. How are you thinking about China right now, and where you would find an entry point in that market in particular?
So I think emerging markets in China are also dealing with this trifecta of issues that we mentioned. In China, you had a correction of the excesses that already happened last year. That was a market that February 2021 was 1 standard deviation expensive. Now it's nearly 1 standard deviation cheap. You also have a growth scare happening at the same time, driven by some of those structural slowdowns in the economy, namely property and low-end manufacturing, as well as the pandemic. So I think for investors, the correction of the valuation excesses is already there in China. Now you need to get a bit more comfortable on the growth picture. And for that, really, I'm looking for 3 things. The first is a redefinition of success when it comes to COVID zero. So it doesn't mean abandoning the policy, which is very tough to do. It's just redefining success, lowering the threshold for reopening. We also want to see that the policy put is still in place in China. So we want to see a little bit more monetary stimulus, maybe a cut in the loan prime rate this month. And lastly, we want to just see silence and regulations for investors to get a bit more comfortable that we're past the worst. And there's an important innovation meeting next week, and it would be just welcome news to not see anything new come out of that.
Gabriela Santos of JP Morgan Asset Management, thank you so much. Just silence, John. I'm sure that we could use that line occasionally.
When are we going to resolve these issues? Hey?
No, it's true.
Can TK stay out a little bit longer? Is that what you were asking for?
No,
that's the issue I'm looking to resolve here.
Is that the issue? It's just silence. We just want silence.
I'll take some sight. Do you hear it today? It's just great, isn't it?
It's just, we're
beautiful.
Just talking.
You can just take a beat. No one's going to fill it in with anything.
Well, I do think, just going back to what Gabriela was talking about with investing in China and investing in some of these areas. Remember when we were talking about how there was no yield anywhere and how high yield was no longer high yield with average 4% yields? You can get an average 22% yield on Chinese high yield bonds right now. That's how high they have climbed. And nobody wants to touch this stuff.
Unfortunately, financial markets don't operate like Main Street when things go on sale. When things go on sale, people run the other way. Yes. And on Main Street, you know what happens. People go into the store and they buy. On Wall Street, they worry that things are going to get worse because you've got a loss of confidence. You've got the psychological shift away from buy the dip. A lot of things have changed in the last couple of months, and a lot of it goes back to the Federal Reserve. That Fed put's retired, and we've got guest after guest coming on today, despite the tightening of financial conditions we've seen, that say they're not ready to step back anytime soon. This is going to be the story through the summer. A lot of people saw Chairman Powell last week and thought him clarifying rate hikes through the rest of this summer was somewhat dovish. And now, given the data we're seeing, given the worries about growth too, start to sound more and more hawkish, doesn't it? Because we're having this tightening of financial conditions. We've got a Fed committed to going further to bring down inflation, and no real sign of that story breaking just yet.
And frankly, it's not just that. If it were just that, maybe we could actually move through it. But it's also an actual slowdown in China, in Europe, in other areas.
Futures right now, down 0.5% on the S&P, on the Nasdaq 100, down by 1 full percentage point. You might have noticed Tom's not here. He'll be back tomorrow. He's really excited about Arsenal Spurs.
Oh, I'm sure he is.
He wants to start drinking early, apparently.
Tots. The Derby.
I cannot believe, Katie, that we're calling this the Tots.
I'm sitting in this chair. I had to do it.
Just can't. Seema Shah's coming up very shortly from Principal Global Investors. Looking forward to that from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the First Word News, I'm Laura Wright. It's been a day of big swings in the cryptocurrency market. Bitcoin had been as high as a little more than $28,000 and as low as $3,000 less. The collapse of the Terra USD stablecoin earlier this week triggered a flight from many popular digital tokens. Senate Democrats were blocked in an attempt to enshrine abortion rights in federal law. All Republicans and one Democrat, Joe Manchin of West Virginia, voted to keep a bill ensuring nationwide access to abortions from reaching the Senate floor. Senate Majority Leader Chuck Schumer said he wanted to put Republicans on record just as the Supreme Court is poised to overturn the landmark Roe v. Wade decision. It's been 2 months since negotiators left Vienna, and expectations are fading that the Iran nuclear talks will resume. The US and Iran won't talk directly to each other, so they communicated with messages exchanged via the European coordinator. For now, European diplomats won't declare the deal dead. That would force the United Nations to reimpose sanctions and take even more Iranian oil off the market. Disney reported subscriber gains for its flagship streaming service that were better than expected. But the entertainment giant tempered its outlook for the rest of the fiscal year, and the company says it will trim spending on movies and TV shows. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal
honeymoon, Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Earnings season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan's spot on.
Delta flying.
Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We are focused like a laser beam on inflation, and the President's made clear that he knows that is the top priority for working families, and therefore his top priority.
Gene Sperling there, the senior advisor to the president and former National Economic Council director. Futures this morning down 0.4, off session lows on the Nasdaq, still lower by 0.75% on the Nasdaq 100. Yields come in again by 8 basis points, call it 9. We can run down to 283.53. The excuse tour. Some people have called it that, Lisa. Inflation. The president keeps talking about it. We had an address yesterday, an address the day before, going through a long list of things that attribute the blame to all of these things that we see, but ultimately also saying the Republicans don't have a plan. And the plan that they do have belongs to Senator Rick Scott. The problem that the Republicans have with that is that the Republicans themselves say it's not our plan. Mitch McConnell said it's not the Republican plan. Do we know what the plan is?
Honestly, I have not seen the Republican plan. How do you have a plan? This is the tricky issue that President Biden is facing, and frankly, both Democrats and Republicans face. How do you have a plan when you don't really have a good solution? There is no silver bullet to how to bring down inflation. And frankly, if you're going to get blamed, what do you do with that?
Let's talk to a member of the Republican Party, Congressman French Hill, Republican from Arkansas. Congressman, let's start there. The president says you have a plan. Mitch McConnell said it's not the plan. What is the plan?
Hey, Jonathan. Lisa, it's great to be with you. You're right, Lisa. There's not a silver bullet here. This is the result of 10 years more plus of suppressed interest rates that have led to increased asset values, and then by the Biden administration, failed policies. They doubled down on spending and increasing demand by adding $4 trillion to spending last year, passed through the Congress on top of the $4.5 trillion that we already spend every year to run the government. And the Federal Reserve was too lax and too late in beginning to shrink its balance sheet and raise rates. That's coupled with the supply chain issues that we have. And here again, the Biden administration has done nothing to unleash American energy or really ease the supply chain constraints on hiring workers, getting truck drivers back to work, easing the logistics burden. So the Republican plan is, first, don't keep spending money like drunken sailors. Well, 2, encourage the Fed to do the work that it should do. And 3, let's unleash the supply side and break down these supply chain barriers.
Congressman, the Republican plan sounds a lot like the Biden plan from what you're saying, because they're not talking about spending more. They're actually talking about reducing the deficit. They are talking about investing in the supply chain. And they have talked about releasing oil and gas and trying to figure out ways to bring down costs. What's the distinguishing feature about what you're saying other than just pointing at different places for the blame game?
Right. Well, thanks, Lisa. I mean, look, the Biden administration policies are the ones who've created this demand side surge on top of low interest rates. It's the $4 trillion that he's added in spending in 2021 that was warned against by Larry Summers, Jason Furman, Steve Ratner, strong Democratic economists, saying it would lead to too high demand in the face of supply constraint. On energy, it's all talk. He's doing nothing to unleash American energy and make it easier for companies to get the permitting, build the pipelines, get the permits for new LNG export facilities, and get our production back up to over 13 million barrels a day.
Congressman, if we could focus on the monetary policy aspect of what you mentioned, having the Fed do its job. In theory, if the Fed does tighten aggressively, it could lead to a higher unemployment rate. It could lead to a slowdown in growth, if not an outright recession, which is something the market in particular is concerned about. Would you be happy to see those things if it got inflation under control?
Well, inflation is a thief. Inflation steals for hardworking families. It makes it very hard. And also it hurts our seniors who are mostly on fixed income. This is a result of bad fiscal policies by the Biden administration and keeping interest rates too low for too long at the Fed. So this is the anguish of central banking faced by Chairman Powell and his colleagues. They have a tough policy choice of tightening and potentially reducing a recession, or not tightening as much and perhaps leading to stagflation or market volatility. It's a tough position to be in, but we should begin to shrink the balance sheet and raise rates. And the Fed should try to do the best it can to achieve a soft landing, which I know is Chairman Powell's ultimate objective.
Hey, Congressman, 2 points you've made in the last 4 or 5 minutes. I'll put some emphasis on them. That this administration made some policy mistakes with fiscal policy, and this Federal Reserve waited too long. Chairman Powell hasn't been confirmed by the Senate for another term yet. Do you think he deserves a second term?
I do, Jonathan. Let me tell you why. Jay Powell has the temperament, the knowledge, and the leadership skills to navigate the Fed through this process. And because he was there and I thought did an outstanding job during the pandemic's height in March of 2020, he knows that the Fed has the tools to do this. I want him to own this issue and help guide the Fed through this next phase that's so challenging.
What do you think of this term ultra MAGA that the president's using at the moment, Congressman? What do you make of that?
What I make of Joe Biden is that he campaigned on bringing the country together, and he's done nothing but divide the country even more in the first year and a half of his presidency. He's constantly saying the dog ate his homework on the exit in Afghanistan, inflation, crisis at the southwest border, and to try to build relationships with Republicans, he calls them names. So I don't think Joe Biden has been very effective in managing the U.S. government or building a coalition to get things done on a bipartisan basis.
Congressman, great to get your perspective on things, as always.
Great to be with you, Jonathan.
Wonderful
Thanks,
to
Lisa.
catch up. Brilliant, as always. Lisa, a difficult moment. To his point at the end there, this is the issue that some people have with this White House at the moment, that it's still divisive.
Look, right now, how much has politics gotten so divisive that a lot of the discussion points have to be shrouded in blame game, honestly, all around. And I think that has become an incredibly polarized political backdrop that you see on Twitter, that you see on Facebook. We could go into all of the reasonings.
Sure.
But, how much is it this White House and how much is it playing into the political sphere in this nation right now? What
is it about Chairman Powell? He seems to be bulletproof. A lot of people come on the show and say that, problems, they didn't do this, they didn't do that. And then the congressman follows it up by saying,
yeah,
second term. I trust the guy.
Who do they replace him with? And frankly, who do they bring in who's not going to disrupt markets, have that learning curve that people talk about before they get their legs under them and stop saying stupid things? How much is that really what they're trying to protect against?
Not going to say what I think. Futures down about
Please
a quarter
do.
of 1%.
Come on.
We rebound.
Oh, come
We're off
on.
session lows. It's fascinating stuff.
Market action.
The Nasdaq 100 is negative 0.6%. And the bond market yields are a little bit lower on a 10-year by 8 basis
Everybody
points
wants
to 284.25. He missed it just in such a monster, massive way. They just missed it.
Everybody agrees that he did.
They kept doing QE. They carried on doing QE. QT hasn't even started yet. Think how ridiculous that is.
So you'd kick him out?
This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Hard to call this a correction anymore, isn't it? It feels like a bear market, looks like a bear market if you measure it. It's a bear market on the NASDAQ. You take some big names, the likes of Apple, they're almost there. Equity futures this morning down 1/3% on the S&P, on the NASDAQ down by 0.8%. The NASDAQ 100 down, what, 27% year to date? Brutal. Something's changing in the bond market, though. Yields aren't higher, bonds aren't lower. Treasuries are rallying again. 4 straight sessions, yields lower by 8 basis points now to 283.71. High of the week, 320, backed away. High of the year, 285 on twos, backed away. That was last Wednesday. We're down another 4 or 5 basis points at 259.21. And it's not just stateside, it's Europe too. The bond market rallying. 4 straight sessions, yields lower. Came close to 120 on a 10-year bond this week. Now back down to about 87 basis points and down 11 or 12 basis points on the session alone. Want to finish on foreign exchange. 103.88. The lows on December 20th, 2016. Right now, 104.22. We are not far off. That currency pair, Lisa, down 0.9%. That euro weakness is biting hard.
You said it really well earlier. Basically, if they raise rates, if the ECB raises rates, it's euro weakness. If they don't do enough, it's also euro weakness. It's sort of damned if you do, damned if you don't there. And that's been, honestly, the common narrative for a while.
A lose-lose, right? Sometimes that's when narratives start to shift the other way, but I'm not sure I want to be the person that tries to call that. I won't go there. The ECB next month, Lisa, I think they've got one of the hardest decisions going as a central bank, because the downside risk to growth is right now. It's materializing. It's not maybe in the future. It's happening at the moment. The inflation rate is too high. What on earth do they do?
Especially because this is inflation that's all the wrong kind. In the U.S., we look at the wage inflation, we look at rent inflation. It's coming from services. People are able to charge more. Not the same in Europe, where it's very much energy, very much imports, and the fact that the euro has depreciated to the degree that it has.
Who'd you rather be, President Lagarde or Chairman Powell?
I think I'd rather be Chairman Powell, to be honest. Yeah, because I've got a second term. French Tail told me that I would.
Well, there you go. If he gets confirmed, we think that's going to happen today. But that was a very good answer.
Thanks.
Let's just cross that to price action. Let's get you some single names, some movers, and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. When you talk about bear market, we've been in bear market territory on an individual basis and an aggregate basis now, roughly for some time now. And you take a look at some of the price action that we're seeing in the pre-market here, that's going to continue. I thought it was interesting. Yesterday, you had the NASDAQ composite. Not only is it down just about 30% from that all-time high, a 30% drawdown. But if these declines that we're seeing in the pre-market now hold through the close, it's actually going to exceed the drawdown that we saw back in March of 2020. And a big part of that reason is, well, all the major members of that index, they've been in bear market territory for quite some time. One of the outliers was actually Apple. Apple shares had been down about 19% from its all-time high as of yesterday's close. If the 1% decline that we're seeing here in the pre-market holds through the day, then that would put now Apple down about about 20%, joining the likes of Amazon, Tesla, Microsoft, and a couple other names that I'm forgetting here. That's the flip side here with the, I guess, what you would call sort of the more stable companies, the companies with real GAAP earnings, real growth, and more importantly, actually real margin ability to grow their margins here. The flip side of that, of course, John, are the names that, of course, didn't have that. You have Zoom, which is down 80-90% here, getting a downgrade today over at Piper Sandler. Those shares moving lower, and Beyond Meat came out with their fiscal first quarter earnings, and they weren't good at all. The bloom definitely coming off the rose. Those shares down more than 20%. Disney has been struggling. Those shares kind of been up, and then they were down. Overall, the numbers weren't bad, but some of the guidance that Bob Chapek gave on the conference call, not really encouraging here. A sign that maybe there'll be a little bit of a slowdown in growth, particularly in that streaming business, and some concern about a year from now what that parks business is going to look like, some concern about a pull forward. One of the reasons why you're seeing a big bump here in the most recent quarter, that may not hold going forward. And then there's the EV space. Interesting note out by the folks at Wells Fargo, downgrading Ford and GM because of the added costs to their EV vehicles. They actually had some interesting estimates. They said that higher raw material costs are adding about $13,000 to the price of the Chevy Silverado EV that they're making, and that for Ford, the Mach-E and their Lightning vehicle that they're making, about $5,000 to $8,000 in added costs just from raw material costs alone. Whether that gets passed on to the consumer, whether Ford eats it, that's a big question. And then Rivian, of course, which is trying to stay the course with its push into the EV space, says it's still going to meet its production targets for the year. Those shares, believe it or not, higher by about 4%.
Hey, Romain, a point you've made repeatedly on the close. If you don't have any earnings, there's no E to make up the PE. You've got a problem right now, haven't you?
Yeah. Big problem right now, and you're seeing that reflected in the sell-off that we're seeing.
In a massive way. Romain, looking forward to the close a little bit later, coming up later on Bloomberg TV, and a little slice of that on Bloomberg Radio too. Tesla down 30% year to date, Lucid down 63, call it 64, Rivian down 80% year to date.
Just sort of shocking, talking about the bubble bursting, and Ford actually sold some of those Rivian shares recently at a discount, which only spooks people more, and we're just seeing that play out.
Joining us now, Christian Müller-Glissman, Managing Director for Portfolio Strategy at Goldman Sachs. Christian, is this a bubble bursting?
Listen, I think you definitely are dealing with a significant valuation reset here. There's no doubt about it. And to some extent, that was in the making. You remember we spoke about it a few months ago, and we wrote about it in our Balanced Bear research. Unfortunately, coming out of COVID, you had this constellation of both bonds and equities being incredibly expensive. And now you're entering into a very challenging growth inflation mix, where I think inflation is sticky, growth is decelerating, and I think the market is now derating those valuations. And as you were saying, in particular in the markets where I guess the uncertainty on the growth and or the earnings is the highest. So long duration tech more recently, and before that cyclicals versus defenses. I think they've also been derated materially.
How far along in this derating, Christian, are we?
Always tough to say, because if you look at valuations compared to the average since the 90s, we're moving below that average now. But we know we're not in the 90s anymore. I think we're dealing with much higher inflation volatility, a very different uncertainty on monetary policy. And even the growth picture, I think, has certain uncertainties, which are maybe more tactical in nature with Russia, Ukraine, and China. But I think there's also some structural questions with regards to what's the next growth engine. So you could argue that the valuation derating could continue. But what I would say, though, is, and I think John mentioned that earlier, I think we start to see the peak a bit in the bond yields. And we also have seen tentative signs of the peak in inflation. And we might shift from a high and rising inflation regime to something where inflation maybe is starting to decline. So that could start to stabilize things a bit.
Hopefully we didn't disrupt anything too much, and anyone's calling from the compliance department to say, please stop.
I think he cleared it perfectly. I asked, is it a bubble? And he said it's a valuation re-rent rating. I mean, that's how you do this diplomatically.
All right, so that we didn't necessarily get the DJ in charge to call and complain. I am wondering what the opportunities are that might be emerging if the derating has been uneven or perhaps heavy-handed. Do you see any opportunities, or do you think that at this point, hiding out in treasuries, in duration, in the dollar seems to be a better bet and just go with the flow?
Listen, I think near term we might easily be stuck a bit longer in a fat and flat range, as we've been saying. The range is getting fatter and flatter, if you know what I mean. So the volatility definitely has been a bit larger. Positioning and sentiment is getting more bearish as we speak, and that creates asymmetry, that creates opportunities. But you still need to find momentum. Like a good trade, a good investment thesis is always built on good asymmetry, kind of more upside than downside, and good momentum. And I think right now you have to be very selective in picking those battles. I think we've been very focused on real assets, and I think opportunities related to that. I think clearly commodities are pretty high up in that range, and commodity-related assets. Infrastructure is a very interesting real asset because it doesn't do only well when inflation is high, it also does well when inflation is high and falling. But I think clearly what we need to engage with in the next 6 to 12 months as we kind of look a bit forward is to really add risk and eventually add cyclical risk, because that's where the market is getting the most bearish. So you can think about at some point a capex cycle driving selective opportunities. You can think about kind of even places that are linked to the consumer discretionary spending, which are clearly a lot under pressure. Eventually, they will provide good asymmetries.
Well, Christian, as you say these things, and as John, Lisa, and I have been talking about the brutal action we have seen in the market, someone writing into me on Twitter that the three of you make me want to crawl up into a ball and cry this morning. And I'm sure there are a lot of people out there who are feeling that way. For those people who just want to pull their money out of the market and go into cash, what would you advise them about how much cash you want to hold now to redeploy when those opportunities you just were talking about present themselves?
Yeah, I mean, this is a very tough thing to generalize because it depends on each individual investor, the circumstances, you know it, like the risk tolerance and these type of things. But I think we've been overweight cash since the beginning of the year. And I think I'm not saying that there's not opportunities emerging for medium-term investors, but I do feel a decent cash allocation still makes sense. I think to your point, I think bonds are starting to buffer a bit. So you could argue that if you're really worried about a recession, kind of starting to introduce duration risk via bonds back in the portfolio might make sense. But what we've been saying is that duration to some extent is not a buffer right now, it's a risk. So it really depends on what you own right now. If you own long duration assets, I think adding duration back in the portfolio probably doesn't make much sense. So I think a decent cash allocation makes sense. Real assets, kind of assets that can protect you from debasement. If you're a dollar investor, that's been difficult because the dollar has been the key safe asset. But if you are a non-US investor, clearly the dollar still has that characteristic that currently it's protecting kind of purchasing power as the Fed is fighting inflation.
Christian, brilliant work as always, mate. Thanks for being on with us. Christian Müller-Glissman there of Goldman Sachs. Just in response to that tweet, if you're an equity market bull looking for therapy, Lisa's not going to provide it. This is not where you come.
I'm good with feelings. We could talk about your
therapy
feelings.
For equity market
honestly,
bulls.
I mean, it's okay. Just lean into it. Allow it to happen.
You want to talk about feelings?
If I were Tom, I'd start singing, but I'm not, so I'm not going to.
Please don't remind us of yesterday. Let's talk about the losses because they're brutal and they're real. We're down 27% on the NASDAQ 100. The NASDAQ composite year to date. On the S&P 500, we're down by 17.4%. Year to date. Lisa, real losses.
It's real losses, and we haven't seen the forced selling yet. When do people actually start meaningfully readjusting in a way that we have not seen?
Futures this morning down another 1% or so on the NASDAQ 100. On the S&P 500 down by 0.6%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the First Word News, I'm Laura Wright. President Biden marked 1 million US deaths from COVID by calling on Congress to maintain funding for testing and treatment. Lawmakers remain unable to agree on how to pay for the fight. Today, the US opens its second summit aimed at quelling the spread of the coronavirus. It would be another jolt to the European security landscape. Finland and Sweden are inching closer to joining NATO. Finland's president and prime minister threw their weight behind an application, and Sweden's government is likely to do so soon. The Nordic countries are seeking to deter aggression from Russia. Moscow warns that there will be consequences if they join NATO. Russia's oil revenues are up 50% this year, despite trade restrictions following the invasion of Ukraine. According to the International Energy Agency, Russia earned roughly $20 billion each month this year from the combined sales of crude and products. Still, the IEA says that new sanctions could change that. The Pentagon is negotiating to buy a tank-busting drone that would be sent to Ukraine. California-based AeroVironment makes the switchable 600, which can fly more than 24 miles and linger over a target for more than 40 minutes. The Pentagon has already committed to send at least 700 smaller, shorter-range switchblades to Ukraine. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
have seen a lot of froth come out of the market, and there certainly was a lot of froth in the market. I think about the retail call buying, on a lot of the meme stocks, on the high momentum names. A lot of that has gone away, but it's also not fully gone.
But it's going. That was Amy Boo-Silverman, the equity derivative strategist at RBC Capital Markets. Futures heading south, down 0.6% on the S&P, and the Nasdaq 100 down by more than 1%. Yields heading south as well by 9 basis points. You can round it down to 10. We're down to 282.45. This is the currency pair that we're all looking at right now. It's euro-dollar breaking down by 1 full percentage point, just about holding on, Bramo, to 104.07.
Okay, so why the extra weakness today? I asked John this in the break, and John said to me, it's the euro. And honestly, there is an element of damned if they do, damned if they don't. But we are getting headlines from the German finance minister about Russia weaponizing gas and about how they are prepared for some sort of gas sanctions. And I do wonder, John, how much that's playing into the outlook for growth.
The economy minister saying things are escalating, and I think it's definitely playing into what's happening right now. It's why Nomura think we can get down to parity in the next 2 months. If you look at the US versus Europe, Europe is more exposed to the story in Russia, Ukraine, more exposed to the story in China than the United States. And that's the channel that a lot of this stuff is playing out in. It's the FX channel. And I'm not even sure how much it's got to do with rates, Lisa, because as you point out, even if they hike next month, is that euro positive, euro negative? I know a ton of people that think that's negative for the currency.
Or is it euro agnostic? I mean, honestly, this has moved away from the ECB's hands, and they have to take actions that they don't seem to be exacerbating the weakness. But honestly, at this point, what will that actually accomplish?
I could keep talking and wait for 103, but it's not happening, so we'll move on. Futures down 0.75% on the S&P. You didn't know, but that's what we were doing. Kriti Gupta joins us now with our chart of the day. Morning, Kriti.
Yeah, good morning, John. The selling really continues, but let's put this into some context here, because on the surface, it does feel like there is a lot of pain in the markets. But if you compare this to the historical trend you've seen since 2009, which brings me to my chart of the day, by the way, and put on some standard deviations. It's a pity Tom Keene isn't here to see this. He would be so proud. You are actually seeing this drop only a 1 standard deviation move from the historical trend. So if you're looking at the technicals here, which, by the way, on an intraday basis has driven a lot of the trading, it's actually not that bad. But before I get yelled at on Twitter, this is important to keep in mind, because how often has the market dropped below more than 1 standard deviation? The answer is not much in the last couple of years, which kind of it means there's a little bit of panic here for the bears and a little bit of positivity for the bulls, if you will, John.
Kriti, thank you. Perfect timing. 103.95. There it is.
It was planned.
There it is. Pretty brutal. And if you want some levels here, 103.88, back end of December 2016. So with the lowest since then. Not pretty, Lisa, not pretty at all.
And what's going to be the reprieve here if there is not any clear-cut shot? I mean, they're already talking about fiscal stimulus. They're going to keep talking about it at the G7 meetings coming up. How much can they get ahead of this, or how much do they just have to ride it out?
We've got to talk about some earnings as well. So let's do that right now with Geetha Raghunathan, the Bloomberg Intelligence Senior US Media Analyst. Geetha, Disney, the Walt Disney Company. Talk to me about the numbers, the way this market has reacted to them, and your thoughts about the future for this company.
Yeah, so good morning, John. So the numbers were actually very, very good, in my opinion. So the 2 key metrics that we were looking for, one was the Disney Plus subscriber growth. We were expecting about 4.5 million subscriber adds. They came in almost nearly double with 8 million. So again, huge success there. Then the other metric that we were looking for was really the park number. And again, they outperformed there. And really, it's just been this huge pent-up demand at the U.S. parks that has led to this fantastic outperformance. We saw them with operating margins that were 300 basis points above peak performance in 2019. So they are way ahead of where they were pre-pandemic levels. The parks have made more than a full recovery. But I think where we're kind of really seeing, this nervousness is investors have gotten so skittish about this whole streaming story. And, just like Lisa was talking about, you're damned if you do, you're damned if you don't, right? So previously it was all about making this pivot to streaming, to direct to consumer. If you were not making that pivot, you were punished. Now, if you've made the pivot, you're getting punished as well. So it's really this very, very funny time. And of course, again, with the parks, there is this economic overhang. Again, investors worried whether they're going to be able to replicate the strong performance, quarter in and quarter out.
Yeah, well, I mean, prices at parks were already inflated even before inflation really took hold. So did their cost way more than it would at the grocery store. But on the streaming story in particular, the ads are coming. And that's not just true for Disney+. Netflix is looking at an ad-supported model as well. What realistically will that make? Will it make a substantial difference?
I think it does. So it does two things for Disney, and they already have a lot of expertise in this field. Remember, they do have the gold standard in video advertising with their Hulu product. And what you see on the Hulu product is with that ad-supported tier, even though they're charging you $7, a discounted fee for the Hulu product with ads, they're also making $7 from advertisers. So it's actually, they're more profitable with their advertising tier than they are without. And I think that's exactly what they're trying to replicate with the Disney Plus service as well. So what it does is it not only boosts revenue and profitability, but it also obviously will reinvigorate subscriber growth, especially if you look across the world where people are very, very sensitive in developing economies to price points. So I think it's an overall good move that keeps both that subscriber trajectory as well as the financial metrics really up and running.
I'll moan about my Hulu pricing a little bit later. All in, it's costing me a fortune, Geetha. Can you tell me what the hopes and dreams are for that platform?
Yeah, so Hulu has really kind of been in this tough spot, John. There's been kind of this custody battle going on between Disney and Comcast. Disney owns 66%, Comcast owns 33%. Disney does have an option to buy it out. But it's really one of those assets. It's a U.S. only asset, so it's not really had much international presence. But having said that, they've really done a good job. I mean, I think just kind of given all the constraints, has it been able to attain full potential? I don't think so. But just kind of given all of the limitations, it's really done a fairly good job in terms of advertising. That's really kind of been the main thrust. They've really excelled there. But I do think that one of these platforms, whether it's Disney or whether it's Comcast, one of these companies kind of needs to own it fully to kind of really take it to its full potential.
Geetha, great work as always. Geetha Raghunathan there of Bloomberg Intelligence. That stock is down 5% in early trading. Brahma, you've said it more than once. It's not about the earnings for Q1, the first quarter of this year. It's show me something that they can't tell you. Show me the future and tell me it's better than people think it is.
And to the degree that they can tell you, it's not great. They're actually talking about waning demand. I mean, yes, they beat their subscriber number, but they talked about how there'd be a cooling off, how they'd be pulling back from investing in certain types of productions. How much is that really just what people are responding to, even though people are still going to theme parks and people are still buying subscriptions?
And as for Hulu, let's go there. Once you've started paying for all of these streaming things, and then you've paid for broadband, we're basically back to the cable bundle, aren't we?
This is your third rail, huh?
We're back there. We're just back there. No, my third rail is on the weekend when you try and find the games.
Right,
and you've got to go from Hulu to Paramount to Peacock.
Okay.
And you can't even find anything.
If there were a bundling kind of service,
sure,
would you be happy to pay the same amount?
For a bundle?
For a bundle that's more streamlined?
Would I just get cable back?
Well, it would be a bundle. It wouldn't be cable.
Do you know why I got rid of cable?
Bundle.
It was never about saving money in the first place. I didn't like the wires. I didn't like the actual cable.
That's so you.
Getting the TV out, connecting to broadband and just keeping the living room tidy and clean and zen, just like me.
Oh, yeah.
Futures down 9/10 on the S&P, on the Nasdaq 100.
The control room's
what are you
laughing.
for? Down 1.4.
that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Tight monetary policy is what's going to be required to get inflation under control.
It's pretty obvious now. They really should have gotten a tightening process going last year.
There may be some economic pain that we have to take in order to bring down inflation.
It's not really just that volatility is now in a new regime. We're also in a new regime of momentum.
In relative terms, there's still a U.S. outperformance story, and let's see how long that lasts.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We go again from New York City. Good morning for our audience worldwide, live on TV and radio. This is Bloomberg Surveillance alongside Lisa Abramowitz and Kenny Lyons. I'm Jonathan Farrow. We're taking a dive here again on the S&P. We're down 1%. Lisa on the NASDAQ 100, down by 1.7.
Not a lot of conviction to come in here and buy. Not a lot of conviction about much of anything. You've got growth concerns that are in the forefront, as you can see by some of the Haven bids, but you also have the concerns about the Fed hiking too much. Not yet stagflation. People still talking about momentum in the U.S. economy, but for how long?
The growth concerns in the bond market, Lisa, for you and I throughout the whole of this week, front and center.
Very much so, because this is a shift. We had seen bonds and stocks sell off, people talking about a hawkish Fed. Rate fears seem to have peaked out, and now we're heading into the next phase. What comes next? What's the consequence of a tighter financial policy with inflationary pressures that really crimp consumer spending?
And Kenny Lyons, briefly this morning, euro dollar with a 103 handle.
Yeah, a really tough spot for the European Central Bank to be in, John, because on the one hand, you do have these inflationary pressures stemming from the energy crisis. In theory, that means you hike rates. Therefore, you could, in theory, get a stronger currency. But at the same time, those very same pressures are causing a real growth scare on the continent. So what's a central bank to do? And also, what's an FX trader to do? In either scenario, if the ECB hikes, if it doesn't, do you want to buy the euro?
What does the Fed do from here? Yeah. We've been going through the wealth destruction for the whole of this morning. what's been taking place in crypto, what's taking place in this equity market, how much you're paying for your energy bills, your mortgage costs. Some of these big names and the moves we've seen, Bramo, so far this year. I talked about Netflix down 72, Facebook down 44%, Amazon down 37%, but Apple in the mix now, almost down 20% off the highs of this year. These are some big moves from some big companies.
Especially because just months ago, people were talking about these being the haven trades. Look at how much cash they're generating. Look at how bulletproof your iPhone purchases are. Look at how people are lining up to spend thousands of dollars regardless of what the pricing is. And now people don't care. This is a change in the concept of valuations, and this is even before we get balance sheet reduction, before we get liquidity withdrawn from an economy that has gotten used to, or some people would say drunk off of it, over the past couple of years.
I only know one happy man right now. It's Tom, triple leveraged, all cash keen. That seems to be, year to date, the only place, Lisa, to hide. And when we came into this year and people talked about maybe building up a cash position, the pushback you got was, why would you want to own cash when you have inflation north of 8%? For a lot of market participants, this is why.
And especially if that cash is in dollars. I mean, if you're earning in euros and you're putting it in euros and then you're going to the US, maybe not so much. But yes, this is basically the real trade that has emerged as the only haven at a time when there's so much other volatility. And how much is that disruptive in its own right, given what that does to other financial markets outside the US?
If you are just tuning in, let's get you up to speed. Your equity market looks a little something like this on the S&P and on the NASDAQ too. We're down 1% on the S&P 500. On the NASDAQ 100, we're down by 1.6%. Futures negative, the opening bell about 1 hour and 27 minutes away. The change though in this bond market, it's not about equities down, yields up. Yields are lower too, by 9 or 10 basis points to 282.45, which is why we keep going back to this three-step process that a lot of people think we're in. They think we're in step 3, from inflation fear to rate response to growth scare. Are we in step 3 firmly, Lisa, given the price action we're seeing in bonds right now?
I'm glad that you asked that, because Christian Muller-Glissman was talking about the volatility and how the intraday volatility is annoying. That was the word that he used, partly because we're flipping between rate concerns and growth concerns. It doesn't feel like we're quite to the growth concern place in the U.S. yet, at least not from an economic perspective. So does it stick? Do you get conviction that we've seen the high in yields? Or can you basically say, look, we're going to get another re-rating as people look out at how much growth there actually is under the surface in the U.S.?
Seema Shah joins us now, Chief Strategist of Principal Global Investors. Seema, we've done a lot of damage, a lot of destruction. Some people might call it carnage in this equity market. What do you look for to know when to step back in, when to buy?
Yeah, it's a good question. I think with regard, we need to see inflation peaking and coming down. We need several months of this just to kind of give us comfort that we are on the right path. I do actually think that growth is going to stabilize. You know, monetary policy, it works with a lag. So we're not really going to see that significant slowdown in growth for at least, you know, another 6 months to a year. So I think as you see growth stay relatively stable and inflation start to come down, you could see a stabilization in equity markets. Is it another rally? I don't think so, but I think you could see a stabilization.
So what do you do with that, Seema? Do you start buying some of those growth names, the big tech darlings?
I think it's not about necessarily the kind of the big tech. It's really about quality. You know, we know that growth is likely to slow down over the next 2 years. We're actually anticipating recession in early 2024. We know that financial conditions are tightening. So that's the time where, you know, you want stability of earnings, you want their big balance sheets, pricing power to deal with the inflation pressures. And a lot of that points to quality rather than specifically about big tech. But of course, we have to say that, look, you know, valuations have cheapened considerably. So as long as we've been able to pick out the right companies with those various characteristics, I think there could be a decent time to get back into that exposure.
Well, and Seema, obviously one of the factors that has weighed on those growth, high multiple stocks in particular has been higher treasury yields. And yet, as John and Lisa were just discussing, the bid has come back into the treasury market, whereas the 10-year was at 312 last Friday. We're now back down at 282. If the peak is in for inflation, is the peak also in on yields?
So I wouldn't say with that much confidence that we've already seen the peak. I think there's a fair amount of volatility still in the market. But if we're looking out the next 6 months, you know, where is our forecast for year end? We do see treasury yields a little bit lower, that kind of 2.6% level. And that's because we are expecting a slowdown in growth. And as soon as you start bringing recession into the equation, it's very difficult to see yields sustainably above 3% for a prolonged period.
Seema, just to build this out a little bit more, if we bounce, where do you think the leadership comes from in equities?
And actually, I think it'll be quality. You know, I think that's where we have to be focused, because you have a bounce, but the growth issues with the Fed continuing to tighten, that is not going to go away. So we need to be picking out the companies very, very carefully. This is where selection becomes increasingly important.
And when you talk about selection, is the focus really on the United States still, even though you are getting such a re-rating, if you want to call that, or carnage, as others would say, in Europe in particular?
Yes, absolutely. You know, we look at the US and we are concerned about the US. But if you look further out, Europe, China, emerging markets, the concerns are even greater. You know, as you've been speaking on the program, Europe is just surrounded by issues. Wherever you look, they are very much challenged. For China, we think some of the weakness is likely to continue, and emerging markets has that food price inflation threat, which I think is going to become a bigger and bigger problem. So for us, yes, US is problematic, but it's the dominant area going forward.
What about the UK, Seema, where we saw actually a growth contraction in March, which was unexpected, and yet Bank of England and Dave Ramsden still saying we got to hike more to rein in inflation?
Yeah, it's been interesting with the UK. You know, we have been relatively negative, the UK, for several years now. But then we have to remember the UK, it's a big dividend play, right? So it continues to see that interest. They are going to be facing growth problems. We already know that from the Bank of England, they're likely to see recession in 2023. And we do see continued rate hikes. But it's that dividend play, the valuation perspective of the UK does actually make it look somewhat attractive.
Seema, awesome to get your opinion on things, your perspective. Thank you. Seema Shah there of Principal Global Investors. Reflecting what we've been talking about this morning, Lisa Cayley, Nouriel Roubini, just on the bond market and the equity market correlation. Nouriel, good friend of this program over the years, usually tuning in, says the following: correlation between bond and stock prices going back to negative after being recently positive. Thus, concerns about inflation hitting both stocks and bonds now give way to concerns, Lisa, about a recession.
Which is what a lot of people are expecting. I mean, even Seema was saying she expects it in 2024. The issue is when. And how do you hide before that, right? I mean, if you expect it in 2024, do you still dance? Do you still look for example, consumer discretionary companies? Because that's going to reassert itself because we still have time left in this cycle. I mean, there's so many questions. If you get the economic call right, as you've said before, John, it doesn't mean you're going to get the market call right, too.
Some of this also is quite self-fulfilling. I got a message this morning, and they were basically asking what happened to all the commentary about that resilient, strong U.S. economy. And in many ways, the data hasn't changed that much. The problem is that markets are anticipatory. They look at the data in front of them, particularly inflation, think about how the Fed's going to respond to that. They look at the financial conditions tighten, and a lot of that exacerbates the things that the markets anticipate, and you know where I'm going with this, and that's what financial markets do. They can shape the events they anticipate. George Soros has talked about that for a long, long time.
But let's be honest. We have seen the ramifications for example, 5% mortgage rates. We've seen sales slow down. Prices not yet,
Without
but the
a
number
doubt.
of sales, the volume of sales slowing dramatically. All of these precursors to more of a downturn. And so we are seeing the groundwork being laid for a lot of the prognostication that's been out there. So it's not completely in a vacuum that people are just having faith that what they believe is going to come to fruition.
And not at all. You're going through the data right now and you're thinking, can the consumer stand up to this? We've been told that household balance sheets are strong, but when you look at the numbers, utilities were up 13.7% from a year ago, the most since 2008, just going off the recent inflation data. 60% of categories have seen prices rise more than 5% over the past year. Heard a lot of banks talk about that. And when you think about where real wages are, real wages have been negative, Lisa, for a 13th straight month. You'd have to admit that to some extent, and we can debate to what degree, that the consumer is going to be hit by that in a significant way.
And already has. I mean, remember the retail sales print that came in negatively in a real basis? You are hearing it around the edges. You're even hearing a little bit of concern about companies maybe not hiring as many people because they're just too expensive.
So if we have a crisis right now in the market, it's a crisis of confidence. At some point, you've discounted everything we're talking about, all the gloom. When is that point? That's the difficult bit of this whole piece. Futures are negative 0.8% on the S&P. The Nasdaq is down by 1.4%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the First Word News, I'm Laura Wright. It's been a day of big swings in the cryptocurrency market. Bitcoin had been as high as a little more than $28,000 and as low as $3,000 less than that. The collapse of the Terra USD stablecoin earlier this week triggered a flight from many popular digital tokens. Senate Democrats were blocked in an attempt to enshrine abortion rights in federal law. All Republicans and one Democrat, Joe Manchin of West Virginia, voted to keep a bill ensuring nationwide access to abortions from reaching the Senate floor. Senate Majority Leader Chuck Schumer said he wanted to put Republicans on record just as the Supreme Court is poised to overturn the landmark Roe v. Wade decision. Bloomberg has learned that HSBC began an internal analysis to help rebuff a proposal to split off its Asian operations. That proposal comes from the bank's largest shareholder, Ping An Insurance, which wants to improve returns. About 65% of HSBC's pre-tax profits last year came from Asia. The bank argues that much of that business is actually with Western clients that gets booked in the region. The sell-off in tech stocks has spread from more speculative shares to the world's biggest companies. Apple is poised to open today more than 20% below its January peak. Through Wednesday's close, Apple erased about $600 billion in market value since its record. That slump has led Saudi Aramco surpass Apple as the world's most valuable company. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan's spot on.
Delta flying.
Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst? Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Jay Powell has the temperament, the knowledge, and the leadership skills to navigate the Fed through this process. And because he was there and I thought did an outstanding job during the pandemic's height in March of 2020, he knows that the Fed has the tools to do this. I want him to own this issue and help guide the Fed through this next phase that's so challenging.
Jay Bulletproof Powell, the Congressman French Hill of Arkansas. At least the Democrats nominate him for a second term and Republicans still love the guy. It's pretty amazing, isn't it?
Well, to be honest, who else would fill that role and be able to smoothly transition? And not just that, but also it wasn't just the Federal Reserve. A lot of economists got inflation wrong as well. There were warnings, but there was a very two-sided and heated debate about inflation. I'm just raising the other side because I know we went hard on the idea of he made a huge mistake, which they are. They're behind the curve.
I remember all those economists saying keep QE at 120 billion as inflation climbs through 5, 6, 7%. I don't remember that at all. Futures on the S&P down 0.8 to 1%.
Hey,
on the Nasdaq
move on, not
down
let me respond.
1.3%. You weren't paying attention anyway. Yields down 8 basis points on a 10-year, 284.25. Greg Vallier's with us now, Chief US Policy Strategist at AGF Investments. Hey, Greg, it's amazing to me that we haven't heard much from Senator Mitch McConnell. What's the strategy here from Republican leadership as the White House tries to define the party by the views of the junior senator from Florida?
Well, let me just make this point, John. Good morning. I think that Mitch McConnell, to use a sports analogy, is content to run out the clock. He's got 6 months to go. That's a long way. I think the Republicans don't want to talk details about abortion. They don't want to talk details about legislation. And they certainly don't like this Senator Rick Scott of Florida saying maybe we need to have more people paying taxes. That goes against orthodoxy in the Republican Party. And then Scott says, well, maybe a lot of these key issues should be sunsetted every 5 years. So we should re-debate Social Security, Medicare, things like that. That has a lot of Republicans upset because the dictate from Mitch McConnell is to just say nothing to try to get through 6 months without rocking the boat.
Greg, that's fine if everybody else says nothing. If you leave a vacuum open and then the White House starts to define you by the plan of the only guy talking, which is Senator Rick Scott, then haven't you got a problem? Doesn't McConnell have a problem now that he has to actually step up and offer a plan? Or do you think that doesn't matter going into the midterms?
I think they'll be vague, John. I think they'll be very hazy. The great wild card here, of course, is Joe Biden's health. And Scott is not exactly subtle. He said in the last few days that Biden has mental issues, acuity issues, and that he should resign. I'm not a doctor. I don't know. I've seen Biden at press conferences where he stutters a little, but he stuttered for 80 years. That he's always had a stutter. So I think if Scott wants to go into that issue, that's going to upset a lot of centrist voters. I think McConnell would like to leave that one alone.
Greg, the blame game is really popular in Washington on both sides. I mean, you're hearing basically Republicans coming out and explaining all the things that the Democrats have done wrong, and the Democrats are blaming Vladimir Putin, they're blaming the Republicans, they're blaming everyone for the inflation that we're seeing. Does the blame game resonate with American voters?
I think it does, Lisa. It's a good question. First of all, when you look at inflation, most Americans blame spending. You know, we spent a little over $5 trillion last year, and an awful lot of voters think that that exacerbated or jump-started inflation, and they blame Biden for doing that. Then we see yesterday an astonishing I'd say, error from a public relations standpoint with the White House as gasoline prices hit an all-time high, announcing we're not going to do this big Alaskan oil drilling. To announce no Alaskan oil drilling on a day when gasoline prices are spiking, to me, is tone deaf. So there is some blame to go around, and I think as a result, you're going to see more support for drilling and exploration, and you're not going to see much more support for big new spending.
Well, and Greg, of course, inflation is felt universally among the American population, no matter what party affiliation, where you are on the political spectrum. But as we look at that spectrum, how many people are already decided on how they're going to vote in November? How much can actually change in the next 6 months?
Well, believe it or not, here we are in mid-May. I would argue that within a couple of months, attitudes will harden. And it's going to be awfully hard, Kaylee, to have Biden have a different perception when it comes to inflation. I think he's stuck with it. There are things he can do. I don't rule out student loan relief. I don't rule out more aid to Ukraine, with the Ukrainians maybe doing better against the Russians. But when it comes to inflation, this all-important issue, I think Biden only has a couple of months left, or the attitudes become locked in cement.
One thing they were worried about, Greg, was energizing the base. Quite clearly, the abortion issues of the last couple of weeks around the Supreme Court has energized the base. Do you think that's done so sufficiently?
A huge issue. There was a show vote yesterday in the Senate, John, that, as you know, didn't really go anywhere. But yes, I think this will be a big X factor. Still another issue where Mitch McConnell would like to run out the clock. The Republicans don't want to get into details. They would like to pretty much avoid the issue.
Greg, wonderful to catch up with you, buddy, as always. Greg Valier of AGF Investments. Just how sustainable is that position from Senator McConnell? Lisa, just wait it out. Wait until November.
Honestly, if the blame game actually works, pretty sustainable, because they've got a lot of blame that they can cast given the anger that people have about the inflation. Honestly, how do they basically just ride that and not have to provide anything substantive on the other side, because nuance doesn't really sell?
We've brought this up a few times, haven't we? Whether the calendar is on their side in the White House. Can things get better coming out of the summer? And it reminds me a lot of the conversation we had last year, waiting for the supply side response for inflation to come down. It did not happen. And here we are again. Citi just published. They say the lack of deceleration in monthly core inflation increases the risk that Fed officials will continue to hike in 50 basis point increments through the second half of the year. That's a risk, not a base case. Jackson Hole in August and the September FOMC may see Fed officials guiding towards both the higher neutral rate and the need to overshoot it. The second half, Lisa, the back end of Q3 into Q4 in play.
And to your point, that just means that timing is not necessarily on the Democrat side in terms of year-over-year comps, because those supply side issues are not abating. I mean, in about 5 minutes, we're going to get the PPI reading. We're going to get producer prices and how quickly inflation is rising there. It is expected to come down, but do we get a new sense of how much momentum there is, frankly, in edifying the Citigroup view? Mike
McKee is in the seat. He's just logged into the Bloomberg terminal. He's in the studio. We'll get to him in about 5 minutes' time when we get that economic data. I'll whip through the price action for you, down 0.9% on the S&P. If you're more constructive, call it down 0.8, but whatever. It's been brutal. On the Nasdaq 100, we're down by 1.4%. Yields are lower by 9 basis points to 283.35. Yields lower for a fourth straight session. So in a few minutes' time, we get a sprinkle of economic data, a breakdown from Mike McKee, and reaction from Steve Risciuto of Mizuho, the chief U.S. economist. For our audience worldwide, alongside Katie Lyons and Lisa Abramowitz, I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame
Connection
sekali.
lost.
Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya